It's like pushing away from the gate at the airport. You're on, it's an on-time departure.
All right, it looks like we're all set. For the Select Committee Capital Financing and Investments on May 18th, Senator Driscoll.
Here.
Senator Guru.
Here.
Senator Hicks.
Here.
Senator Kinski.
Here.
Senator Nethercutt.
Here.
Representative Hallinan.
Excused.
Thank you. Representative Harshman.
Here.
Representative Larson.
Excused.
Thank you. Representative Obermuller.
Here.
Representative Schwartz. Vice Chairman Nicholas.
Here.
Chairman Perkins.
Here.
You have a quorum.
Thank you. Now if I can just get my computer to work and I have the agenda, we'll get started. You know, sure. I guess we'll just, you know, so much for the one that I made notes on.
State Auditor's Office.
Thank you. All right, so I'm going to go ahead and first item on our agenda, we're called to order. I don't have particularly any remarks today. We're just welcome. We'd like to just welcome anybody who, we've got Senator Guru is online, if I saw that right and remember that right. So we're glad to have you, Senator Guru. So hope hold things down wherever you are. With respect to today's meeting, we're going to go back we're going to go back and look at the annual comprehensive financial report. We're going to go back and look at what happened there, and then just more importantly, we just want to see where we're going, and everybody wants the same thing, which is, you know, to make sure that's timely. We just want to see how that's going there, and been a lot of changes at the Treasurer's office. We want to understand that and how that's going along, and because we all want this to work out the same way. So with that, we'll go ahead and get started. I think first on the batters or the order is the State Auditor's Office. So please come forward. Madam Auditor, welcome. Edie, welcome. You go ahead and take a minute, introduce your team, and give us any introductory remarks, and then let's jump in.
Mr. Chairman, thank you. My name is Christy Racinas, and I'm currently serving as your state auditor. So to my right, I have my very competent and capable deputy, Edie Troutwine, who I think you all know. And to my left, I have Erin Benskin. She is the head of our accounting division, and she is responsible for producing, along with her team, the annual comprehensive financial report, or ACFR. Erin's a CPA, and she's been with our office for 5 years, so.
Go ahead.
So, Mr. Chairman, my intent, and I'm happy to do whatever serves the committee best, we have a handout that I would go over relatively quickly and just sort of give an overview of the process that we follow to complete the ACFR, and additionally a status on the current ACFR. Like I said, that'd be my intent, and then certainly take any questions unless you desire otherwise.
No, please proceed.
Okay, Mr. Chairman. So, and again, I recognize that much of what I say is probably already known to the committee, but I think there's a lot of misunderstanding around the different players' roles in this process. So some of this you may have heard, but I'll cover it anyway. So the fiscal year ends each year on June 30th, and the state of Wyoming's activities are audited each year as of June 30th, and that has to be by an external independent auditor. So the Department of Audit is actually responsible for contracting for the audit of the annual comprehensive financial report. And currently McGee, Hearn and Pice holds that contract. And the reason that the Department of Audit does that is because the State Auditor's Office prepares the report, and it's important to have that separation so that we aren't selecting our own auditors in essence. Now, the SAO, or our office, is statutorily required to produce the annual comprehensive financial report, or ACFR, by December 31st of each year, and that's in statute. And so the process we go about, it starts pretty early in, May to June of each year. We reach out and we gather an extensive amount of information from state agencies, including the state treasurer's office, so that we're able to compile the ACFR. And in order for us to meet that statutory deadline of December 31st, we have to receive certain items, dozens and dozens of items from different agencies in September, October, and November of each year. And so we keep a lot of internal calendars, and then we also have what's known as PBC lists for agencies. That's a common auditing term for prepared by clients. So in that realm, that means we provide agencies with a PBC list of what they have to us and when, and then we have check-ins and whatnot and follow up when agencies are delayed. So one thing that I want to sort of hammer in a little bit is once we receive information from agencies, it takes substantial work and time and review to take that product and turn it into the ACFR that is published and then given to the auditors to audit. So essentially, we if we get information on day one, we can't have the ACFR on day two. So a lot of time is involved by both our office after that information is received, and then additionally, when that information is submitted to McGee, Hearn, and Pice, there's substantial work and review for them to actually audit the information. So any delay of receipt in information from an agency kicks that whole process back, as we know. And so that process works fairly well, particularly when we receive timely information from agencies. But another really, really important component is that information is that it's accurate the first time it comes through. So that process gets recycled whenever we have inaccurate information or questions, and that really then produces this back and forth. And that's honestly, Mr. Chairman, where loads and loads of time get eaten up. For example, I'm sure Aaron would say, I'd rather have a PBC a week late and perfectly right than on time and wrong. That on time and wrong, it ends up creating more work for both the agency submitting it, our office, and the external auditors. So essentially, when there's a delay in information, but then there's also a question of accuracy, that's really when things start snowballing and sort of falling apart. So for the 2021 ACFR, so that would be for the period ended June 30th, 2021, several agencies were unable to meet ACFR deadlines, and the issuance of the ACFR, as we know, is severely delayed. The STO was unable to produce timely cash and investment information to us for the 2021 ACFR. And we've also submitted the 2021 PBC list specific to the STO. That's one of your handouts. And that details what documents were late by what documents were on time, what were late by a few days versus a few weeks versus several months. So in October, back in October of 2021, STO deadlines were beginning to slip, and we stayed in good communications with the STO and had meetings and emails. I just want to make sure everyone knows that we were communicating constantly amongst ourselves to try to keep on top of that. So then in November, STO staff experienced a major COVID-related setback, which really snowballed the delays that were already happening. So by the 1st of December, we knew that we were clearly not going to be able to issue a final ACFR by the end of the month, by the statutory deadline. So at that point, we sent a formal letter to the governor, the president of the Senate, speaker of the House, and chairs of joint appropriations to notice them of the issuance delay and the reasons why. And that list of people, just as an aside, the governor and chairs of JAC and leadership that's who we're required to give the ACFR to, so that's why we notified those people. So in mid-December, MHP, and MHP is what we call McGee, Hearn, and Pice, just in case anybody didn't know that, and STO developed a phased approach to complete cash and investments to try to meet a new issuance date of January 31st. Essentially, what was done at that time is they tried to lay out a roadmap for getting the ACFR over the finish line. On December 30th, we sent an unaudited draft to the statutorily required individuals to attempt to meet our statutory deadline so that our office was not, not complying with statute throughout this. One of the other things that happened is in January, we also notified the Wyoming Business Council that our ACFR would be delayed. And the reason that's important is Wyoming Business Council is a component unit of the state, and they are unable to issue their audit report until ours is issued because they get cash and investment information from us. So towards the end of January, January 26th, MHP sat down again and drafted a comprehensive memorandum outlining a new roadmap to, again, get the ACFR over the finish line with, in conjunction with our office in STO. And that pegged the final issuance date as of May 31st. So there's been a couple bumps in the road on that memo and that very extended roadmap. But by and large, that has gone okay, and we are still optimistic to have an issuance date of May 31st as of this year. So at the end, on the bottom half of the second page of our memo, I just dropped in historical ACFR issuance dates for the last 10 years for the state of Wyoming. Again, you'll note that 2021 isn't on there as it has not been issued yet. So, Mr. Chairman, I'm going to stop there. That was a lot of information pretty quickly, and I'm happy to accommodate any questions.
All right, thank you. Questions for the auditor? Questions for the auditor? Go ahead, Mr. Vice Chair, go ahead.
Thank you. Mr. Coach, so tell us what the practical and real effects are of not having a timely ACFR.
So, Mr. Chairman, Representative Nicholas, thanks for that question. And at a very high level, we're in uncharted territory. The state has not issued an ACFR in modern times that we know of. So some of the impacts is that currently the state has for 22 consecutive years, 21 consecutive years, received a Government Finance Officers Association designation of excellence in financial reporting. Essentially, that's an external third party that says your financial statements are accurate, very good, and meet a very, very high standard. And one of those components is timeliness. So we've received that designation for 22 years. We would lose that designation if our ACFR is not issued. So financial statements are used to determine the state's credit rating, and that credit rating could be detrimentally impacted. Again, we're in sort of uncharted territory. We don't know how or when that would happen. And then failure to issue an ACFR, one of the maybe most impactful things is the state receives about $1.2 billion a year in federal funding. Now that's in a normal, non-pandemic year. As you all know better than anyone, we've received multiple $1 billion in 2020 and 2021. But again, even in prior years, we were sitting at about $1.2 billion. We don't get that money if there's no financial statement issued. Now, the caveat to that is a very late ACFR doesn't necessarily mean the feds are going to stop sending us money. actually not being able to have an audited financial statement, I think that would really compromise our ability to receive federal funds. The other thing that, again, we haven't seen in prior years, even when there's been a smaller delay, is we're impacting other agencies' abilities to issue their own financial statements. So I mentioned Business Council, but YDOT's audit is now being detrimentally impacted because they again have to have cash and investment information to be able to issue their audit. The Office of State Lands also has a specific audit on their state revolving fund program and clean water and drinking water programs, which has also been held up because of this delay on the main audit. So, Mr. Chairman, those are, again, some things that we don't fully, those are some things we know of that could be impacted, but we don't fully understand the potential detrimental impacts of not having an ACFR.
Go ahead.
So compare us to other states. I mean, is this a common problem in other larger states, or have more complicated systems than we do? Do you know what?
Okay.
Mr. Chairman, Representative Nicholas, I don't, we do actually have data on all states. This is very late for an ACFR. Typically 6 months after your year end is a good standard, and that's what most states are able to meet. The pandemic has admittedly, messed up a lot of things and caused delays. And we didn't submit this data because it's loads of spreadsheets about different days, but most dates from most states are in November and December of each year, certainly some in January and February, but by and large, all states are usually issued in December, similar to what ours has been until the last couple of years.
So, and in layman's terms, just tell us, what information were you not receiving? I mean, can you be particular about the particular data that was late?
Mr. Chairman, Representative Nicholas, I'm not sure that I'm the best person to answer that, and I may have Aaron chime in. But from a high level, the ACFR, let me back up. Many businesses have a balance sheet and an income statement, and most folks are familiar with what those are and what that is. Your balance sheet is a point in time of all of your assets, and then your income statement is the results of operations over a year, so revenue and expenses. So that's essentially what the ACFR produces for the government. It's a point in time financial balance, and then the results of operations as well. So the problem is that our entire net position, so essentially the state of Wyoming's financial position, their assets are about $32 billion, and that's as of last June, and I'm using rough numbers a little bit. So the cash and investment information that we struggled to get finalized in an auditable form is close to, it's about $27.5 billion. So there's no balance sheet without that information. In particular, this year, what really derailed the train, and again, I'll let Aaron chime in, was the in-kind transactions, which I know this committee has been familiar with. Aaron, do you have anything else to add as far as specifics of what we were missing?
Mr. Chairman, Representative Nicholas, the only thing I would add is that the information we get from STO for cash and investments deals a lot with securities lending accruals that we have to make, as well as investment income that was received in July and should be credited to June. So they provide that to us on a fund level, and then we roll that up into the fund classes that are presented within the ACFR for the state.
And then just a further follow-up, Mr. Co-Chair. You say you think you'll be able to have everything by May 31st. So do you have all the data now so that you're in the process of assimilating it because you, through the walkthrough?
Mr. Chairman, Representative Nicholas, yes, we believe we have everything now to complete the work. Obviously, what has happened over the course of this is typically the audit's done in December. The external auditors are a very, very busy entity. They have lots of clients, both governmental and private clients, other than the state of Wyoming. And so they've really gone above and beyond several times over to manufacture additional staff time after the first of the year in January and February and March and April to devote to this job that was supposed to be done in December. So that now is in a good place. But again, now we're both internal for our staff as well as MHP staff. And I don't want to speak for them. I mean, Brandy is here to respond to that. But it is now, we are now nearly at year end 2022. So we're competing with, there's a lot competing for everybody's time, I guess.
And so with your work with the treasurer's office, is it your understanding that things are improving and the systems are improving so that we don't find ourselves in the same predicament in the future?
And just to put a finer point on that, so, I mean, we are, we're 6 weeks away from the end of the 2022 fiscal year, and this whole process starts again. So where are we as finishing up 2021? And so now, and soon to start compiling information, the deadlines that you look in the charts that we have. I mean, there's a lot of deadlines start to come up here in just the next few months. Compare and contrast that with where we were and where you see us for 2022, which is going to be the next one, which starts, like I say, is the fiscal year's over in about 6 weeks.
Mr. Chairman, Representative Nicholas, we're concerned. We are, it's hard to start out sort of just barely not quite even finishing the other one and having to turn around and figure that out. I think, and I'm going to have Aaron say this much more intelligently than I do, but a lot of the potential for problems in the 2022 ACFR hinges on how much is corrected by the STO prior to June 30th. But I want to have Aaron again say that more intelligently.
Go ahead.
Mr. Chairman, so one of the things that we have to do is what we call fund balance restatement every year before we can start the next year's ACFR. And that is due to the fact that in Wolf's everything is cash-based and the ACFR is accrual-based. So we make adjustments per GAAP and GASB to the financial statements to present them in the ACFR. We do not make those adjustments in Wolf's. So we have a process called fund balance restatement where we get our beginning balance in Wolf's for the new fiscal year to match what it should be had we made those adjustments in the accounting system. The complication now is the in-kind activity and having to go back and unwind what we recorded in the prior ACFR versus what has been done in Wolf's and what has not been done in Wolf's. We've not had to do that before, so we don't really know how time-consuming that is going to be for us in order to get our beginning balances where they should be to start preparing for the 22 ACFR.
And so, and specifically, I mean, so, as you go back and look at our issuance dates, in 2018, it was in December. In 2019, it was not quite, it was a little bit before the end of January. And for fiscal year 2020, it was in February. And now we're looking, we got our fingers crossed for a May 31st. So what's happened that we, I mean, specifically, I mean, you've talked about it in generalities, but what's happened specifically that has created the problem? Is it mostly the in-kind transaction issues, or is there more to it than that?
Mr. Chairman, I'm not sure that my office is the very best person to answer that question, but I think the in-kinds are the main piece of it. But there are other complicating factors as well with just way more internal managers and whatnot. Aaron, did you have anything to add to that? Yes, and Mr. Chairman, you may recall, you were maybe not on JAC at the time, but if you look at those first 8 years, one of the first things when I got in office, I said, the statutory deadline was December 15th. And I said, well, geez, that's impossible to make. The timeline is really hard to meet December 15th. And you could see that we were always just after December 15th. So we went and requested with the legislature, which the legislature did for us, a change to December 31st. And then that has not been successful so far, so.
Okay, thank you. All right, anything else for us?
No, Mr. Chairman.
Any other questions? Any other questions? Go ahead. Go ahead, Representative Obermore.
Thank you, Mr. Chairman. I just have a question, or I just have a statement to ask you if you agree with it or not. As you laid out who is impacted by this, would you agree that the legislative process was also impacted by this? We went through a budget session without even knowing where we had been. And when you don't know where you've been, it's pretty hard to know where you're going. And so I think that there was a huge impact during the budget session of not having this information. Do you agree?
Mr. Chairman, Representative Obermueller, I absolutely agree. And I can't speak to this with intelligence, but my understanding is there were also impacts to Craig that was probably maybe even more detrimental to the legislature. I recognize that probably most legislators don't read the ACFR page for page, but it's from a larger sort of public transparency issue, it's difficult to say we don't know what happened 21 months ago, and it's hard to make decisions if you can imagine that in your own personal budget. If you're trying to, say, make a decision to buy a house and you don't know what your salary was last year, you don't know how much money you have. It's kind of a similar comparison indeed.
Okay, thank you. Go ahead, Representative Obermore.
Yeah, thank you. Just one follow-up on that. You mentioned that legislators don't look at it. I think the people that are trying to lead do look at it, and that when you look at the goldenrod, that's just a small slice of the macro picture of the audited financial statements. So I would just say that it is an important piece. Thank you.
Mr. Chairman, I would just say this is the most the ACFR has ever been talked about, and we wish it was under more pleasant circumstances, but Erin and her division are really excited that everybody knows and cares now about what it is and recognizes that it is really important. It's a really important piece of our financing structure.
Okay, anything else? Anything else? Anything else for the auditor? All right, thank you very much.
Thank you.
All right, Mr. Treasurer and your team, come on up. Okay.
To your, I guess, questions about what we can and can't do, and I concur that the in-kind transfers that's happened over the last 3 years has been a big part of this. And we finally found out after doing it for almost 3 years that essentially we can't do it without a buy and a sell process going through. So you actually have a beginning of an end in that transfer process. It's a little bit of a misnomer as far as the transfer, because what the accounting experts told us is that you have to have that. We operated on quite some time, in that in-kind transfer process without that occurring. And that essentially, I think what we did to make sure we knew what had to happen, it was bring in KPMG, MHP, have a good discussion about what can happen, what can't happen, and how it should happen. So no more in-kind transfers. So that, as far as any continued process interference and accounting interference, has been taken care of. The other areas that, from my perspective, I have to look at different things in policy. That was one of the things that I made a decision on policy, was to stop those. And we'll get the toothpaste back in the tube on the ones that have occurred, and work on that in the every time that we have a rebalancing every quarter, we're able to put some of these things back and right, or if there's a change in asset allocation, we're able to rebalance in some manner or form to where we start sweeping the in-kind transfers that had occurred off the books, so to speak. So that's the policy decision I made. The other policy decision I made was to myself go in and look at the communications. The auditor didn't know exactly where some of the other problems were. A lot of that was in communications between our custodial banks and the accounting system, and essentially the managers. And so there was a lot of confusion in that process. I asked Lisa Jordy Spellman to address that, and she's going to address that, I think, this June 2nd in the IPS, and then we'll have definitely an agreement about how those communications occur, so we can identify the different types of incomes, the different types of return to capital, and the different reporting standards that should be uniform within all the managers and our custodial bank. So that policy decision will take care of the other underlying problem that we had as far as that communication. And I want to thank Katie for giving me all those emails to go through so I could get an idea and a grasp on that. And both Katie and Lisa, and a lot of hours with staff going through the managers and working with getting an agreement on how to uniform that reporting standard. So it reports automatically from the custodial bank to the accounting system, and so you don't have that error problem with different people. So those are two things, that policies that I've changed, that's going to take care of the issues that we saw pop up and kept getting worse. The other policy decision we're making is that anytime we have any suggestions from any staff members, whether it's in investment or any place else, that we're going to go to the experts in accounting, which is MHP and KPMG, to make sure that the way it should be implemented in the first place. So we don't get a situation where you're running down the wrong road, and because you forgot to turn your navigator on, and it takes you another 3 hours to get to your destination, or another 3 months to get to your destination. So we're making sure that we're using those experts to make sure that we're navigating in the right direction in any changes. And so it's something that before we go one step forward and 3 steps back, whether it's legislative changes, whether it's changes that we're looking at internally or other people bring to us that thinks that will increase our efficiency or capabilities, we want to make sure that those things have been vetted, with the accounting systems and with our software developers and essentially custodial banks and the accounting firms that we employ. So everything moves forward without any backsteps. So those are policy decisions that we're implementing to make sure that we do things always right the first time. So with that, I'll leave it to Katie, because Katie, yeah.
Mr. Treasurer, just want to follow up on just a couple of those questions. So can you, I mean, as we went, I mean, I think, well, like you said, we were doing in-kind transfers, we've been doing it for several years. And what was it about the in-kind transfers that changed over time so that it went from not being, wasn't really much on anybody's radar to now it's on everybody's radar?
Yeah.
Was it just quantity, or was there something else? Was there something more to it than with respect to the in-kind transfer?
Quantity is a big part of it, Mr. Chairman. The number of transactions went up, I don't know if I'd say exponentially, but they went up a lot. And the complexity of them, because of the different privates that we put in and the liquidity that you have in privates, and I guess the inability to a lot of times price private appropriately, because privates, if you price them, you go to a secondary market, usually it's a lot less than what that you necessarily would have in the original thing. There's just a lot of variables in that to actually get a buy-sell agreement in those different types of illiquid assets. And there's some real estate assets where there just simply isn't a market for them. And so those are ones that you would like to be able to trade, but you can't get a buy-sell. So we're gonna make sure that we always have that buy-sell. That's what our accountants told us. You have to have a beginning and end to every transaction. And when you have transfers, you just don't have it.
And then if I, just to follow up, and I know, I just got a note that Senator Drew has a question. We'll get to Senator Drew's question here in a second. And then I think you mentioned that as you went through, you're looking for, as you came up with, I don't remember the exact words you used, but you came with new accounting, and so you're going out to get technical expertise or asking, I think you said use the term accounting experts. So who is that you're going to now? Is it KPMG and if I understood what you said, you're going, if you've got a question internally now, you're going to somebody to get it so that you can kind of get it resolved and know and have a better idea moving forward.
I'll kind of give you an idea where we had a question about whether you should have unitized or planned sub-accounting. And so we got the experts that would touch. And so what we did is we had a Zoom meeting, and it was with all of the parties within our office, plus all of the parties outside of our office, which was MHP, KPMG. It was with JP Morgan and with Broadridge, our accounting team. I left anybody else out, Kitty? No, I think that was all. And so those are all of the players that and they all had a different opinion on it. And essentially in that one, JP Morgan years ago said that, planned sub-accounting is the way to go. What they told us this time is that they've got two funds that are unitized. They came on that way to the custodial bank as unitized funds, and their other 95 funds are planned sub-accounting, and similar to our planned sub-accounting, although we have a lot more detail in our planned sub-accounting than most other funds. And they didn't have any internal expertise, but they thought there was an outside provider that if we did unitization, that they could contract that outside provider to provide, expertise at their level for them to put that on. Now, JP Morgan has their own problems, so I'm not going to talk about them on an open mic, but I'd certainly talk to you about those some things that Lisa and the staff are working on to make sure that we get them on board as to way we would like to see the custodial banks handle different issues.
And just clarify, JP Morgan is Wyoming.
Custodial bank.
Custodial bank, right.
Right. Wells Fargo is for our cash depository, and JP Morgan is for the rest of it.
Okay. And then there was, the other reference we had was about, I think another issue that came up was one of the things that's created a problem in addition to the in-kind transfers or the number of internal managers. And I think we'll talk more about that. I think that's our back office accounting, and I know you're working hard on that.
And you'll have a report on the progress on that. That's part of today's, and so that'll be included in some good detail with Bloomberg and the other accounting, build out that we're having. You'll get a good update on that and how that all is going together and really coming along quite well.
Okay, thank you. Senator Grew, are you still out there? You have your question?
Thank you, Mr. Chairman. Yes, I do. I got a couple.
Sure, go ahead.
That's all right. Thanks. I'll just follow through. Good morning, Mr. Treasurer. Thanks for being with us. The auditor kind of gave some numbers, and I just kind of you're the treasurer, and so I want to talk to you about them and make sure that I understand it correctly. Right now, is it true that we're shooting for May 31st to get this ACFR complete? Is that the date you've got?
Yes, I believe that's the date, and Katie can go into the details on that, but I've got the same information that the auditor gave you, that we've handed off everything that they need to proceed, and it's on somebody else's court and desk now.
I follow up, and that being, now we're on May 18th, and so we're 5 months and 18 days past the time when we should have had this. And right now, the auditor said that this could, since we're in uncharted territory, as she said, or uncharted waters, it could put in jeopardy $1.2 million in federal funding, also delay WBC, YDOT, OSLI's reporting. Is that how you see it right now? Is that a fair statement?
I think the federal funds, I think, had a COVID grace period that runs to the 1st of July, but I'd have to check on that to double check and see whether or not this instance falls under that grace period.
Okay, but to the best of your knowledge now, that as far as the rest of all those things are true.
But I think he's referring to the delays in the ability of YDOT and Business Council and OSLI to finish up the reports that they have to make.
I would really defer to Katie on that. She has a lot more versed on the details as far as the different agencies.
Okay, Katie?
Mr. Chairman, if I can follow up on one more.
But we're gonna let Katie answer that question.
Oh, okay. Okay, thank you.
Good morning, Mr. Chairman and Senator Guru. My name is Katie Smith. I'm the Administrator of Financial Accounting for the State Treasurer's Office. My understanding is that there have been no implications in the YDOT audit, the WBC audit. They've been able to finish out. I actually had conversations with their comptroller 2 months ago trying to finish out their journal entries. And I have no knowledge of there being any federal funds being implicated.
I mean affected. I think you said implicated, but I think you mean affected. That you're not aware of any federal funds that have been affected by the lateness of the report.
Correct.
That's what you meant. Okay. All right. Go ahead, Senator Guru.
Okay, so we got some conflicting information here. Is that the way I have that, or am I missing something?
Mr. Chairman, Senator Guru, I believe the auditor was referring to if there was not an ACFR being submitted, that there would be implications. However, we have a deadline of May 31st to have an ACFR actually submitted. I think she was referring to it if it had not been submitted.
Okay, thank you for helping me clear that up. And then the last question, or not the last question, but the other question I had in that series is this business about our bond rating. And Mr. Treasurer, for you, you're pretty savvy in all this stuff, know a lot more about it than I do. What do you think this delay is going to do with our bond rating? You think it's, have you been hearing anything? What's your take on that?
Well, I know that there was some discussion about UW bond rating, but this had no effect on it, the UW bond rating, and our CIO can talk to that specifically because he has the details on that as far as there was some, and even last year, before the federal funds came in, and you're all aware of the structural deficits that we continue to run, or prior to the infusion of the federal funds, that was going to, those structural deficits were possibly going to have some effect on our bond rating. Now those have been, pretty much wiped out by the federal funds, and I think that's a bigger concern in the future as far as bond rating. Plus, if we have our revenues from minerals, again, before this Ukrainian war propped up our mineral industry, that was going to possibly have an effect on our bond rating. So there are other things to play out there, Senator, that I think that we have to be very, very cognizant of, and make sure that even though we're fairly flush right now in a lot of different areas, that as you guys know, it can disappear real quick. So Chairman, the revenues here, I think that he's keeping a close eye on it.
Mr. Chairman, if I can continue, yeah, I agree, Mr. Treasurer, although I don't think anyone in this room really has much influence on what happens in Ukraine or Russia or the Eastern Europe, but I know we have control over this process, and that's what I want to get back to. And I'm concerned because I've sat in these meetings before, to be honest with you, and I've been given dates tantalizingly close to the end of these meetings about when this is going to be done, and now we're getting one again today. It's May 18th. It's going to be done May 31st. What happens if that May 31st date doesn't come into play?
Well, Mr. Chairman, we're confident it will. If you want to know the particulars about how that's going to occur, I think Katie can give you some more color on that.
Go ahead, Katie.
Mr. Chairman, Senator Guru, I have worked with the auditors extensively the last couple of weeks. I have no reason to believe it will not be May 31st. Brandy Maru, the partner at MHP, is here, and we just talked to her 2 seconds ago about, did she see that there being any issues with that issuance date? She did not. And she can testify to that as well if you would like to speak to her.
That's fine. Thank you very much, Mr. Chairman. That's all I have.
Okay, thank you. Any other questions for the treasurer? I think we've got some more from some of your staff, but anything else from the treasurer at this point?
Yeah.
All right, so Mr. Treasurer, anything you want to sum up? And I think then are you going to have, tell us, are you going to have
I
Katie,
think
or are you
that
gonna have Dawn?
the details and the reports, I can paint you the picture, but you're going to get the details that'll tell you, exactly where we are on these, what's being accomplished, where, the Broadridge is, where we are with Bloomberg, where we are with all of those different things, where Katie's at, the simultaneous process of running this different budgets on different systems, and what KPMG's part of this is. Katie's, she's the lead person with KPMG on that. So, you've got the experts here that are working it day to day. I keep track of them. I'll tell you one short story, and it'll be short. Katie was at her computer the other day, and I like to go around to the office and see what they're doing. And she said, "Look, Mr. Treasurer, look what this does. It goes in here from JP Morgan, and we only have to put it in once, and there's these 6 things over here, and they just automatically fill, and so nobody has to touch the keyboards and put them in, and she was just really ecstatic about the process and what this new accounting software is going to do to make people's lives, your life, my life, and the folks that are on those desks, and getting this done a lot more accurate, no more fat fingers, automatically transferring the data to the system where it's supposed to be. It's a step up from 1996 to 2022, and it is going to be good for this state.
I thank you, and we'll get more into that here after, a little bit later. Right now, we're still focused on the annual comprehensive financial report. So Katie, do you have anything else for us on ACFR? I know we're going to talk a lot about updates and how things are going in the office. Anything else for us on that?
Mr. Chairman, I know Deputy Williams had submitted a report, attachment A, in the STO's entire report. I'm happy to go through that on some bullet points, but I did also want to clarify a couple of things with the in-kinds and why those are now an issue. We knew that we had issues with in-kind starting in fiscal year 19. The reason why they've really reared ahead in awareness for everybody is transparency. We finally moved them out of cash because they weren't truly being recognized. They shouldn't be recognized as cash, and created balance sheet accounts. By reporting those transparently on at a glance, the portfolio packet, and doing that, that's really brought awareness to the in-kinds. We knew we had issues in 19. We dealt with those in 19 and in 20 and worked through this new transparency to put them where they should be going forward into 21. And that's why they really reared their head. So I just want to clarify that on that piece as well. And also, I think it's also important to note that with the issuance dates, I worked in ACFR before I went to the state treasurer's office. I did that for a few years before I came to the state treasurer's office. And I can tell you, being there, the cash and investments were not nearly as complicated as they are now. They have grown in huge complexity, as well as growth. I mean, 3 years worth of asset allocations hit in June of 2019. And you can see, based off of the auditor's report, the 3 years after that and where we started to slowly decline and delay. So I just wanted to clarify that point as well. As far as background, I just want to go over background really quick. I know the auditor had hit on this, but of course the goal is that all of us meet together, SAO, MHP, STO, we meet together and we talk about the PBC list, that prepared by client list. There are a lot of unattainable deadlines on there, and we, the STO, are forced to do draft PBCs to be able to comply with some of those deadlines, or just be late because we do not have the information in time to be able to produce those PBCs. We agree upon that. The drafts are extra work that we have to do. And it is also another area of manual error that could potentially happen, but we do that to try to give them as much information as possible, as early as possible, because those deadlines are set.
So on that, looking at some, just reading, and you just said it, but I'm reading back from attachment A. So the external auditors establish a timeline for your office and the auditor's office. You guys weigh in on the reasonableness of the deadlines, and the final document is agreed upon by all. But then sometimes your office, the STO, is forced to acknowledge deadlines that are impossible to meet for various reasons. For example, spending policy PBCs are due August 15th, but do not make spending policy calculations and transfers until the close of September 30. So I'm puzzled by that. Why? So could you explain a little bit more from your perspective? Why are we, and I know MHP's here and we'll talk to them about it too, but why are we agreeing or putting down on the schedule PCBs why are you agreeing to PCBs that you know you can't meet because the data is not even available until in this case, it's a month and a half later.
Mr. Chairman, great question. We agree with that clause, that's a great deadline to have. However, be aware that that's impossible for us to meet. So we make sure that they understand that those deadlines are not going to be possible. We can provide a draft, we can provide a prelim of where we're standing at that point, but we are not going to be able to provide the final. As you've heard from the state auditor's office, it is a huge implication when you get prelim work. It's not final, it causes a lot of back and forth, right? It can delay the process. So we do give them that clause that you're going to get it, but it's going to be prelim. Is that going to be worth it? They have determined on a couple of the PBCs it will be worth it. The due to, due from, the loans receivable. Some of those PBCs that we prepare, they want a draft form to at least get the ball rolling, knowing that the final version is not going to be ready till later.
So, so how many more, so you've given this one example of the spending policy calculations, and the spending policy calculations, why are they not available until almost the end of September?
Statutorily, we are required to make those transfers by the end of September, and that's when we finalize our numbers. We have distributions that, Mr. Chairman, that fall into the next fiscal year that are attributable to the prior fiscal year. And we also have FMRs that we receive in the next fiscal year that are also
SMRs
attributable.
are-
Oh, federal mineral
Oh,
royalties.
FMRs, okay,
FMRs.
FMRs, okay.
We get
Yes,
those
sir.
in the prior fiscal year that are also attributable to the prior fiscal year. And so we also have to take July and August receipts and distributions into account when we make those when we do the spending policy calculations. So a lot of those calculations can't be finalized until around the end of September when we make those transfers.
And so so it's from your perspective, it's a timing mechanism with respect to when you receive the information.
Yes.
Is there anything that the legislature has done or can do to help move those up, or is that just a matter of the federal reporting from, with respect to FMRs, for example?
Mr. Chairman, right, that it's federal. It's when we get the information from them. We get it monthly, but it's an accrual of two months prior. So it's just the nature of the beast on that one.
Okay, and so what you're saying then is you can kind of sort of do, you can have everything done that you can do with the information you have, but you can't finalize the FMRs, for example,
Yes.
until you don't get that information until sometime in middle to end of September.
Yes, Mr. Chairman. And a lot of PBCs that we do, so the spending policy PBCs flow into another PBC called the due to due from. So that's another thing that PBCs flow within to each other. You need the first one to get to the second one to get to the third one in a lot of instances. So if that first one is delayed because of whatever reason, or you're in a draft status on that first one, you cannot finalize all of the subsequent PBCs after that. And so that's something to also take into consideration. A lot of these go through. For instance, spending policy calculations flow to a due to due from PBC. And we cannot finalize the due to due from until we have the spending policy calculations finalized. So there's a lot of that as well. So it becomes a trickle effect. It becomes a snowball because you're fighting against trying to get that finalized and then trying to finish out the rest.
Oh, and so, but just one final follow-up on that, Katie, and that is, so if we go back, I mean, the FMRs have been coming in on September 30 for a long time, and we were getting some of that stuff done. So we're getting that stuff done. It wasn't necessarily causing us to delay the issuance of the ACFR. Is there anything different about that now on those deadlines than before that contributes to the overall delay of the financial report?
Mr. Chairman, yes. Historically, the way that the FMRs were being recorded and deposited were deemed incorrect. And we worked with LSO on a new policy on how to record those and in which to say we received or earned in what fiscal year in which we got them. And the way that historically had been done was deemed to be inappropriate. So we changed our policy 2 or 3 years ago. We worked on that with LSO, Don Richards and his staff, and we got that into an alignment and an agreement on how those should be recorded going forward. And that has been part of that issue. Now it's not just received, it's when earned. And so that's part of the delay.
So if I can just mirror that back to what I think I heard. What I think I heard was that previously you just looked, and when those FMRs were deposited, you say, all right, we got them, and they were earned when you just cash basis essentially. And so in moving to the accrual basis, now it's not just when you've been received, but you have to verify when the actual production occurred for which the minerals were paid to make sure it's being credited to the prior period. So whether it happened in May or June or July in particular, those 3 months end up and having those closings and making sure you've got the right FMRs in the right period. Is that the issue?
Yes, Mr. Chairman, that's exactly it. We found through investigative work that the BLM and the ONRR, the federal reporting agencies, are doing it in 2 months arrears. So really, May is happening in July and June is happening in August, which is why we have that delay into the 2 months of the next fiscal year for those calculations.
Okay. Another question? All right. Okay, so anyway, sorry for the interlude.
No,
Keep going.
That's okay. So a lot of those PBCs, right? It just is part of that process, that background. I just want you guys to have an understanding of how that kind of works with the PBC list and how we come to an agreement before we even start everything. Now, challenges in the fiscal year 21 audit really stem again, and you guys have heard this echoed a trillion times. We're short people. We don't have enough people. That's always been the nature of the beast. So much so that we actually lost somebody. My staff is overall very young. The most seasoned person I have is 4 years, which is extremely short in the time frame of what we do. It takes almost that long to actually get a gist of how we do business and what we need to do for investment governmental accounting. However, one of my 3-year vets left. She ended up leaving the agency in August. She did not have work-life balance. Her workload was too high. The stress and pressure was too much, and she didn't want to live it anymore. So she left. That caused a huge implication in workload. I was one that actually cross-trained her in all of her practices, and so it ended up being on my shoulders to carry those things out and cross-train other staff for backups for her. So that was a huge implication. My most seasoned employee went on maternity leave in October, and congratulations to her. However, she was our GASB guru. She's my in-house CPA, and as much as she worked her little tail off to get everything done she could before she left, obviously we had implications with some of those PBCs not able to be finalized before she was out on maternity leave, primarily due to alternative investment managers. Those figures don't come in until way later in the next fiscal year. So she did work diligently, but that also was another backstop for us. I know you heard from the state auditor's office, we did get hit with COVID, me in particular, as well as 2 of my staff. That was a huge implication, and then thus forced us to submit things unreviewed. My goal is to have a manager review everybody's work, staff work, and then I do a final review on all PBCs. It was not possible at that point. We were already so far behind. And in order to not be further behind and have the scrutiny of being late, we decided to submit those. It's not ideal and it was definitely uncomfortable, but we were trying to get things out the door so we weren't delaying the audit any further. And so those things kind of perpetuated some of the issues. However, in December, once I got back from COVID and my staff was finally recovering, we were getting back on track, we worked with MHP consistently. So once we submit PBCs, as the state auditor's office testified to, there's a lot of back and forth, right, with ACFR and with the external auditors. We do a lot of PBCs that not only flow through ACFR's division, but we also submit some straight to the external auditors. So there's a lot that we do that even ACFR doesn't see. And so there's a lot of back and forth and questions. It's just part of the audit process. It is what it is, but it is extremely time consuming. So in December, we started that back and forth and in-kinds blew up, for lack of a better term. We started looking at historical journal entries that had been booked. Now, STO does not book any journal entries for financial reporting purposes. That is not our role. We provide numbers for the ACFR. They then do the journal entries for the financial report. There were journal entries that we were looking at that had been booked prior and trying to assess the accuracy and the need for those journal entries. This led us down a path of potentially doing a total rework and a brand new PBC for in-kinds. And it was kind of, as you can see from our report, called the do to, do from. It was going to be an extensive PBC kind of on that end of a do to, do from to record all of these in-kinds. We spent all of December working on that. It was a brand new PBC, all hands on deck. We did not take vacations for the holiday. I had staff working over to try to get that done. And it was later determined after submitting it and walking through it that it was no longer needed for the audit. So that got us into January. And in January, we started looking at the income reconciliations. Those have historically always booked into a net amount. We've always had some discrepancies on that reconciliation. However, they were booked in net amount. This year, for the fiscal year 21 audit, it was a bigger number. And so the auditors asked and required us to go and make all of the allocations for every adjusting amount. For each manager, it is different. Every amount is a different cause, a different effect. Every amount is potentially in a different year. So we did extensive work. I was held hostage for 3 weeks. And I went through that and outlined every single adjustment that was material for the audit. And did that by fund, by pool, and was able to provide that. We also went the extra level and provided the journal entry in which should be booked in the financial report and in what period, whether it be prior period adjustment or current year adjustment. So that was extensive work that was never required before. And then was also in addition, the journal entry analysis as well. So that was additional work that was done. However, we met that deadline. We were ahead of schedule, and that was at the beginning of March. And then the last final piece, once we get all of our PBCs done, we can finally start working on the fiscal note, which is note 3. And you need to have everything pretty much done to be able to finalize that. And so we started working on that as well. There was a final adjustment that we needed to make on that a couple of weeks ago. I worked with the auditors on that and got that submitted over. And I know that I correspond with Aaron a lot from the state auditor's office, and it was in their hands about a week ago, so they could submit their final draft. So that is kind of the in a nutshell version of the fiscal year 21 audit and the demise and some of the causes of our delays. Going forward, I'm excited. I'm excited to see this accounting system. We have a lot of good things coming up. As the treasurer alluded to, I get giddy. I like to nerd out on it a little bit. It's very fun for me. We have a great accounting system that's going to be flipping the chart of accounts on its head. It's actually pretty remarkable what we've done in this past 6 months. We've completely restructured our chart of accounts for the new investment accounting software in less than five months. We're going to start paralleling next week with the new system and the old system, and that's pretty remarkable to be able to do that fast. That will be very exciting, and then slowly starting to integrate that JP Morgan data so it's streamlined into the system. Huge advances for us. Thank goodness all of you and your colleagues approved 5 new positions for our division. That has given me the ability to segregate out my division into 3 units. So we have the treasury unit that handles the depository side of things, distributions, endowments, PPIs, TDOAs, public purpose investments, time deposit on account, things like that. And then I have the operations middle office for investments that will handle trades, cash management, the directives, the daily grind of investment activity, the daily balancing, things like that. And then with these new positions, I'm able to create a reconciliation and audit unit, which is going to be fabulous to have 6 people, I think 6 or 7 people in that unit, totally dedicated to doing reconciliations on a monthly, quarterly, and continuous accounting basis. Even some of our PBCs that we technically do at year end, I'd like to see those happening more routinely throughout the year, so it's not just happening at the year end process. So having that additional staff will give us that ability. So that's going to be very exciting to have. We're looking for people. Currently, we have a few positions effective immediate, thank goodness. So the hunt is on, and we're anxious to find those people and have them be a part of the team. So a lot of good things. We also are going to try to facilitate KPMG. Currently, they're working on the income reconciliation process right now to try to get us through some additional adjustments that are needed for fiscal year 20 numbers. However, until we're fully staffed and we're fully seasoned, it's going to take a couple years for a full staff to go through an audit twice to truly have, the foundation that we're going to need. So until then, we're going to try to facilitate KPMG. I have to end up training, all of these accounting firms that come in, I have to end up training them. So I don't want that training to go to the wayside. So it'll be great to utilize that and have them help us through the audit and kind of help if we have absences or illnesses or things like that, and help bridge that gap in bandwidth that we have right now. And then, of course, cross-train. We cross-train all the time. So that is also a priority on our list, as always. And then just enhanced communication. I feel like communication has been probably the best that I've seen since I've been at STO with SAO. I think it's been really positive. I think it's grown tremendously. Same with the auditors. And so just continuing that trend and keeping the communication up.
So Katie, you used a couple terms, and I think you're using due from, due to, and due from.
Yes.
Okay, and what's the difference between that and manager income and bring back?
So, Mr. Chairman, due from is where one state fund owes money to another state fund.
Okay.
And a manager income bring back is where you are assessing what earnings have been earned from a manager and asking them to raise those funds to bring them back in cash from the manager.
So give us an example of why one fund would owe, was the due to and due from, was that an outgrowth of the intra-fund transactions?
The in-kinds, Mr. Chairman?
Excuse me, the in-kind transactions, thank you.
No, it was not, Mr. Chairman. That is a standard report that we always have. So for example, there are transfers that are made for spending policy. So one fund moves money to another fund due to that spending policy, the tips, right? The two corpus kind of tips from the reserve. Those are all considered due.
It's a cash management issue?
Yes, it's a due from, because at year end, those were not there, but we are making those moves because of the earnings that are sitting there for that prior fiscal year. So it's considered a due to, due
So I
from.
think what you're saying is you've got to make distributions, you've got to do these things, and some funds have extra cash, some funds don't, and so you move that around to accomplish that. Is that what's going on? And then you balance it later as you deal as you
These are
reconcile that.
usually, Mr. Chairman, they're statutorily driven transfers that are happening in the next fiscal year for the prior fiscal year for spending policy. When we're moving funds from a reserve to, or PMTF, the earnings go to, you have some that go to LSRAs, the 2.5 that goes to the general. Those are all due froms, because it's truly sitting in MO1 currently, the Permanent Mineral Trust. It's owed to these other funds in that following fiscal year. So that's a due to type instance.
And then the term you were using this in there, you began, you're talking about these manager income bringbacks, and then these worksheets on auto recurrence for manager income bringbacks. What are those? Can you help me understand? I think I know what that means, but what? Go ahead and explain the manager income and bringbacks.
Mr. Chairman, so the managers report to JP Morgan on a monthly or quarterly basis, and we get a report that spits out what the earnings were, income and gains or losses that were incurred from that manager. We then assess those, and then we bring those back for distribution purposes. So that's that bring back. We have to bring back the cash from the manager to hold it for distribution.
And so you've got to reconcile the income that's been recorded with that, what's actually brought back or the bring back.
Yes, Mr. Chairman.
Okay, thank you very much. That's a JP Morgan item. All right.
Yes.
All right. Anything else for any other question? Go ahead, Jerry. Excuse me, not Jerry. Representative Obermuller.
Thank you, Mr. Chairman. Does the Treasurer's Office, do you generate your own accrual basis of financial statement?
Mr. Chairman and Representative Obermuller, no, we do not.
Follow up, Mr. Chairman. Would that be a useful process to take it to that level on your side of it? It seems like there's a circular motion going on here that's creating some difficulty trying to work through the auditor's office and the auditor, the outside auditors, and it kind of flows back and forth and around. And you have these direct lines to the auditor's office apparently that, or the outside auditor's office that kind of skips the process of going through the, I'm just wondering if you have any ideas on how the structure of that ought to be, or whether it makes sense to prepare audit or take your own financials to a completion point. Thank you.
Mr. Chairman and Representative Obermuller, you're exactly right. We've talked about that extensively, about us doing more of the financial reporting pieces of it, having more understanding on what is happening at the state auditor's side for where do our numbers go? How does it affect the financials? Because I think once we know more about that and we're able to encompass that, we can do some of that work on our side. It's historically been a separate duty, right? The state auditor's office handles that. We provide the numbers like an agency would, and then they do the financial reporting. But I think as we've had discussions with the external auditors, it becomes there's a lot of gray and confusion with our numbers. They're far more complex. There's a lot of layers there, and it would be advantageous to have some of that be more collaborative between the two.
Thank you. Anything else for Katie? All right, thank you, Katie.
Thank you.
Mr. Chairman,
Yes,
Lisa Jordy Spillman, General Counsel for the State Treasurer's Office. There's been discussion relative to new managers and asset allocation, and I just wanted to provide this committee a little bit of color on that. If you go to the RVK performance report that is part of your materials on page 29, please.
Hang on, let's
The monthly investment performance analysis, page 29.
Mr. Chairman.
But I was just looking for the actual page number in our packet. If somebody's got
Is it
that.
this?
Yes, sir.
Mine just went blank. I think I just blew out of my memory.
Dated March 31.
That's correct, March 31, Mr. Chairman.
All right, go ahead.
So since I looked at this morning, since Treasurer Meyer has come on, there are 30 new managers on this list of investment managers. And so how the process works is the Investment Funds Committee makes recommendations upon receiving recommendations from RVK and our office for asset allocations. And then the SLIB votes on that and it becomes part of the investment policy. Then Patrick and his team review the spectrum of asset managers in that particular area, and they make selections. That goes to the Investment Funds Committee, who then approve those managers. Then the process goes to our office, both legal and the accounting team, to do all the setup and the ongoing administration of that. So this report lists those managers, and there are whole new categories where every single manager, for example, the bank loan composite on the right, every single manager there is new since 2019. Emerging market debt composite, every single manager there is new since 2019. The bottom half of private equity, every single manager there is new. Small cap US equity, every single manager there is new. So I just wanted to make sure that this board understood the volume of work that our office has undergone since 2019 when Treasurer Meyer came on. The second point I'd like to address is related to the characterization earlier with respect to manager income and JP Morgan. Now, when we are funding these investment managers, we do it one of two ways. One, we create an account at JP Morgan, we drop money in the account, and that manager manages it based on our instructions. That's called a separately managed agreement. The other way is we join a private fund. We join that private fund by way of a subscription agreement as a limited partner, and we join with Wyoming's terms via a side letter. Right now, we are in the process of changing those contracts, both with the side letters and with the investment management agreement, so we can be super clear on exactly how the managers are to characterize their returns to JP Morgan. We're amending our contract with JP Morgan, saying you have to be completely clear with every manager how you expect to receive those returns. And we're making the policy changes, we're making recommendations to the IFC and SLIB for policy changes so that both the custodian and the manager are required to report returns in a way so that in the future we can avoid some of the situations that we had here where the managers were characterizing the income in a way that was a little bit inconsistent across the different managers. So that's how we're trying to address that concern that was raised.
Okay. All right. Thank you.
Thank you.
All right, next we've got is Brandy Maru here from MHP. Hi, Brandy. So appreciate you coming this morning and visiting with us. And so you've heard this discussion here, and I know you've got a few things here, but why don't we go ahead and just turn it over to you, and you've heard our discussion. We're mostly interested about, kind of what happened and what went wrong and where this went south, and how do we, and obviously the more important issue is, how do we do better? And so, as the outside auditor, we wanted to get your perspective.
Good morning, Mr. Chairman, and thank you for having me here today. For those of you who I've not met, my name is Brandy Maru, and I'm a partner with McGee, Hearn & Pies, and I also serve as the engagement manager.
Oh, and slow down just a little bit. You have old ears up here.
Sorry. So my name is Brandy Maru. I'm a partner at McGee, Hearn & Pies, and I serve as the engagement partner for the State of Wyoming audit, both the ACFR as well as the single audit, which is the audit over the compliance funds. Mr. Chairman, as you mentioned, my intent for my presentation was to provide an overview of the audit, my perspective on what caused the delays, and then my recommendations to prevent these issues from continuing to occur. So from a high-level perspective, an audit is an evaluation of a subject matter for the purposes of opining on whether it's reasonable. So specifically, when we audit the financial statements, our intent is to opine on whether those financial statements are reasonably stated. You have two parties in an audit. You have the audit firm, which is MHP, and then you have management. And we primarily conduct the audit with the state auditor's office, the state treasurer's office, and then we do actually work with all of the different agencies throughout the state as well. So our responsibility for the audit is to obtain reasonable assurance about whether the financial statements are free of material misstatement, whether that be caused by error or fraud. Because of the inherent nature of audit evidence, we cannot provide absolute assurance that all material misstatements will be detected. The financial statements themselves are the responsibility of management, and you've heard about those responsibilities by both the STO and the SAO today. So in addition to drafting the financial statements, they're also responsible for establishing their own accounting policies and establishing and maintaining internal controls over the accounting for all of those transactions. To provide some historical information, and this information has been provided by both the SAO and STO. From fiscal years 11 through fiscal year 18, the state's audit was always completed in December at an average of 172 days subsequent to June 30th. And that is in comparison to 196 days for all of the other states. In fiscal year 19, that increased to 207 days, and then fiscal year 20 to 241. As you just heard from the STO's attorney, the activity within the state treasurer's investment portfolio has grown significantly in that time frame. In fiscal year 17, we show $20.5 billion of cash and investments across 36 managers. Fast forward to fiscal year 21, $25.5 billion across 56 managers. That's a growth of 24% in the cash and investment volume and a 56% increase in the number of managers that are being invested. So I'm hopeful that will...
Mr. Chairman, could you just repeat those numbers, those last numbers?
Yes.
Go ahead, Randy.
So there was a $5 billion increase in 5 years, which was 24%. And the number of managers increased 20, which was a 56% increase.
Thank you.
And Mr. Chairman, from an information perspective, I'd be happy to provide any of this information that I'm discussing today in a written format to to the committee. I've been out on medical leave the last couple of weeks, and so this is my first day back, but I would be happy to get that information to you.
I apologize you have to return medical leave for this, but anyway,
Not a
glad
problem
you're
at all.
Mr. Chairman.
go ahead, Senator.
In what period of time was that again?
Those numbers ranged from fiscal year 17 through fiscal year 21, the past 5 years.
And Mr. Chairman, to follow up,
Go ahead.
if in providing that information, I'd also be curious, while the number of managers went up by 20, there may have been turnover in the managers as well. So there may have been much more manager activity than just a net increase of 20. I'd be curious on some numbers on that one.
Mr. Chairman, Senator Kinski, that information would need to be obtained from the Treasurer's Office, but I do concur with you. As the attorney just discussed, there were a number of new managers since fiscal year 19, and these would just represent the managers that had balances at the end of each fiscal year. And there have been numerous turnovers of managers in that 5-year period.
Right, thank you, Mr. Chairman.
Go ahead. All right, continue.
All right. So looking back at the audit issues that started in fiscal year 19 and continued through fiscal year 21, I think that there are 3 primary issues to talk about today. The first has been discussed, which is in-kind activity. In fiscal year 19, there was a $13.5 million net loss across 5 managers. That grew to a $27.6 million gain across 18 managers in fiscal year 20. And then in this past fiscal year, there was a $141 million gain across 25 managers. So a significant increase in volume of in-kind activity. The reason that in-kind activity causes so much complexity from an accounting and a financial reporting perspective is that essentially as those in-kind gains and losses are being recognized, the state is effectively distributing those gains and losses within WOLFs. However, from a GAAP and GASB perspective, that activity doesn't exist. So at the end of the year, we have to work with the Treasurer's Office and the Auditor's Office to effectively undo all of the accounting that has occurred within each of those fiscal years. It gets more complex as time goes on. So if you have a fiscal year, let's say you have a fiscal year 19 in-kind gain of 20 million. If that manager then subsequently liquidates in fiscal year 20, you essentially have to take the fiscal year 20 transaction, pull out the distribution that was done the prior year as an in-kind under a different distribution method, and then allocate the remaining difference with where the investment is being held currently. So you can imagine that when you take activity from 19, 20, and 21, and we still have a significant amount of activity that exists across multiple years, the accounting for that becomes more and more complex. As Katie mentioned in her testimony, in December, we met with the Treasurer's Office. It was their original intent to try to absorb as much of that in-kind activity as possible. If my memory serves me correctly, I believe that in December it was also decided to eliminate in-kind transactions moving forward.
So we have so that would give us a half a year for 2021 then?
For fiscal year 22?
Excuse me, fiscal year 22, yeah.
Correct.
Okay.
Yes.
And going through there, the reason it became a bigger problem for you as the auditor was simply I mean, they had a significant jump in increases and it went from being relatively immaterial to material.
Correct, Mr. Chairman. In addition to the volume, the reason it became more complex is we realized that once those managers started liquidating, that ultimately that cash needed to be put where it needed to be in the financial statements themselves. So while this in-kind activity was being accounted for internally, each year at June 30th, we being the state auditor's office and the state treasurer's office were effectively eliminating that activity from the ACFR itself. And so each year that goes by, you have to, which was a point that Aaron Benskin made, you have to restate your fund balance and know which activity you need to eliminate and which activity you don't. And
I think I get what, so let me give you an example here. I think I got that. So this kind of first started to show up in like 2019. You had this in-kind transfer. Now, if there's a position that's liquidated, you had an in-kind transfer, but in 2020, the position is liquidated in 2020. So I have this cash, this income in 2020, but actually because the in-kind transfer, part of it was actually back in 2019. And so you have to go back not only allocate the income, but you've got to allocate and reconcile the cash as well to a transaction occurred 2 years, in our example, 2 years previous to the fiscal year in which it occurred.
Mr. Chairman, that's correct. And that's where the due to, due from came from. If the STO was going to absorb those in-kinds into prior gains and losses that had already been recognized, from a financial statement reporting perspective, we were going to have to record due to, due froms to move the cash to the funds that it should have been in because it had been previously eliminated from prior financials.
Okay.
So the in-kind activity, I think, is one of the biggest issues that has impacted the last 3 years. The second issue is investment income. So at the same time in-kind activity started happening, the investment income reconciliation also became more complicated. In fiscal year 17 and 18, the original documents provided for audit reconciled investment income within $225,000. In fiscal year 19, the unreconciled difference jumped to 21 million, of which 14 million was related to in-kinds, leaving an additional net 7 million unreconciled. In fiscal year 20, the unreconciled difference increased to 43 million, of which 28 million was related to in-kinds, a net of 15 million. And then in fiscal year 21, the initial income reconciliation did not reconcile by 247 million across 43 managers. Of that 247 million, 141 million of it was attributable to in-kind activity, leaving the remaining difference of 106 million across 35 managers. At that point, as Katie testified earlier, we started looking at those differences in January. We worked with the STO to try to identify which managers had the biggest unreconciled differences to try to help them focus their efforts. And they were able to identify 99 million of reconciling items across several managers. And so ultimately, the investment income was reconciled to a difference of $7 million, which from an audit perspective, we recorded as an uncorrected misstatement. Are there any questions on the investment income reconciliations?
No, and we'd appreciate, you said you can submit that stuff in writing so we can pick up those numbers, we can see those numbers. Okay, thank you.
Mr. Chairman, I will certainly do that. Also from an investment income perspective, to provide some information, we worked with the Treasurer's Office and we tested all of the reconciling items that they provided to us. Some of the causes for those reconciling differences were improper classification of transactions between JPM and the state. And again, the attorney spoke previously about how they are trying to work with their investment managers and JPM to ensure consistent classification of that activity moving forward. There were some improper cutoff of income recognition issues that happened, income that was perhaps recognized in July that should have been recognized in June, errors accounting for bond amortization that had been sold, and then obviously timing differences of recognizing realized gains for prior year in-kind activity on liquidating managers. And then another issue that was identified is, Mr. Chairman, what you discussed with Katie earlier is income brought back. So the Treasurer's Office was working with managers to identify what income was available to bring back. They were bringing back that money essentially before JP Morgan had recorded it as well. So again, timing differences were a significant cause of those unreconciled differences. And then ultimately, those are the two most significant issues, but obviously those issues are so complex that it took a lot of effort to get those resolved. And so as a result of that, a lot of our other requests that we had and work that we do with the Treasurer's Office was put at the back of the audit to try to address these issues that were most pressing and that were needed by the State Auditor's Office to be able to complete their work.
So, I mean, so this ultimately ended up in a significant amount of increase in workload, not only for the auditor's office, the treasurer's office, but also your office, I would assume.
Mr. Chairman, that's correct.
So, and your bid was a fixed price bid. So how did MHP deal with all of its additional work? Did you bill the state of Wyoming for that, or how did that work? with respect, it's a little bit different it's a different thing, but just from your perspective, what happened with MHP and the fees based upon all the issues that arose?
Mr. Chairman, our proposal to the state is a fixed fee. We have not submitted any additional fee or billings to the state as a result of this additional work. We did work with our staff and our clients. We requested some of our clients be pushed back. We reallocated some responsibilities to make our state engagement team members available to get the audit finished. But at this point, we have not requested any additional billings of the state.
Co-Chair, just to follow up on that.
Go ahead.
Did you, how do you monitor your time so that can you then demonstrate how much additional time you put in and versus what you expected to put in and or what you anticipated over and above what you did, say, the prior years or as in comparison?
Mr. Chairman, Representative Nicholas, so for any of you who've worked in public accounting, we track our time in 6-minute increments, which
Only
is...
one person up there has worked in public accounting. So-
Those of you in professional industries can appreciate that. But yes, we do have the ability to look back and see how much time we have put into the engagement and how that compares to prior years.
And have you done that? How much extra time did you have or have you put in?
Mr. Chairman, Representative Nicholas, I have not taken the time to analyze that.
Is that because you're afraid to look at it?
Primarily a focus on trying to get the audit completed at this point.
So is that something you can, I mean, I think it's important for us to know what your time obligations are, and obviously that may have impact. When do you bid on your fixed fees?
I believe that fiscal year 21 was the second of our 4-year contract. So the proposal, I believe, will come out, I believe, next summer, the RFP.
And so when you provide us that materials, I think it would be useful for us to see how your workload changed or increased, so we have an understanding of that. And I bring that up because one of the issues that we have is how do we determine the value of our in-house investing and whether or not we're making money with it, if the whole thing is a good idea. To know that, we need to know how much additional workload will be in the future and what we can anticipate the operational costs will be going forward.
All right, so anyway, we digress. Please continue.
So, Mr.
Oh,
Chairman.
wait a second. Our resident CPA has a follow-up. Okay. You'll hold off? Okay, please continue.
Mr. Chairman, the final portion of my presentation is related to our recommendations that we'll be making as part of the completion of our audit. I have 6. The first is to eliminate the in-kind activity, which we had multiple discussions with the Treasurer's Office around in the past couple of years. And as I mentioned before, I believe that activity ceased in December of 2021. At this point, we will need to start working with the Treasurer's Office to absorb all of the remaining balances that have been previously recognized internally, but have not yet been recognized effectively through a realized gain or loss. The second recommendation is to complete reconciliations on a quarterly basis. Again, the Treasurer's Office is currently utilizing KPMG in those efforts. We would recommend that investment income by manager be reconciled between JPM and Wolf's. The cash and investments by manager should be reconciled between JPM and QED. And then the total cash and investments should be reconciled as well.
What was the last one?
The total cash and investments overall. Our third recommendation, again, there's been a lot of discussion about staffing resources, and the STO has recently been approved for 5 new positions. I would encourage the Treasurer's Office and your committee to continue to review their staffing to ensure that it grows proportionally with the investment portfolio, the diversity of managers, and the related activity. In addition, as we've heard today, as that activity becomes more complex, those positions that are being granted will need to be considered for more experienced positions. Hiring someone out of college or individuals with no accounting or investment expertise are likely not going to meet the needs of the state's growing complexity in their investment portfolio. And then one of the other items that I've talked at length with the Treasurer's Office about would be a best practice, which would be to really group their different investment managers by investment type, equity, fixed income, alternative, and then give each of their individuals that are responsible for this accounting and reconciling practices similar types of investment managers to work with, so that they become experts in those investment managers, those investment policies, and potential reconciling issues that may come up with them. Recommendation number 4 is a technology recommendation, and again, they're in the process of implementing their new accounting system. Over the course of the last several years working with the state, there's a significant amount of work that's being done manually through Excel spreadsheets. It is their hope that the implementation of this new accounting software will significantly decrease that manual work, which, as we all know, is subject to human error. My 5th recommendation, and this was again touched on briefly in prior testimony, I think Representative Obermuller spoke to it, but I do think that there needs to be increased cross-training and understanding of the operational and financial reporting responsibilities between the Auditor's Office and the Treasurer's Office. So that it's true that the Auditor's Office gathers all of the information from all of the different agencies to compile it for the ACFR. However, as previously discussed, the Treasurer's Office assets make up 26 of the $32 billion of assets. So obviously the majority of the assets are being handled by the Treasurer's Office. And it is very complex activity. And so currently I think that there's unclear responsibilities as to who's responsible for accounting for that activity. And to take that a step further, how is that activity being converted from a cash basis, which is how the state operates throughout the year, to an accrual basis at June 30th? Operationally, throughout the year, the state is very focused on their investment managers and the strategies and policies by investment pools. However, from a financial reporting perspective, the state auditor's office is focused more on the different opinion units of a financial statement. And so that leads to some, in my opinion and perspective, some frustration between whose responsibility is it to accumulate this information at year end and put it in a format that we can audit. I think it's also important to note that it's very difficult for the auditor's office and the treasurer's office to understand what it is that each of them do. As we've talked, JPM is the primary investment custodian. However, there are 10 investment pools with different policies and strategies. There are 56 managers invested across those pools. There are 80 fund classes that are used from a financial reporting perspective, and those 80 fund classes comprise 450 individual funds. So there is a lot of activity there for both of those agencies to be able to understand and gather all of that information, and have the treasurer's office, who deals with this information on a bigger picture perspective as working with the investment managers and a portfolio as a whole, to then be able to take that information down into the different opinion units that is required to be reported in from a financial statement reporting perspective. And then my last recommendation would just be to continue to have better communication within the treasurer's office between their investment management team and their accounting team, so that each hand understands the implications of what is required when changes are made. So for example, this in-kind activity, knowing what the lift would be from an accounting and financial reporting perspective, and be able to weigh the benefits and costs from an investment management perspective as compared to an accounting perspective. So I believe that a lot of those recommendations are also consistent with what was found in the CLA report.
Okay. Thank you. Senator Guru, I think are you out there? Do you have some questions for Ms. Maru?
Yes, Mr. Chairman.
Go ahead.
Thank you. Good morning, Brandy, and thanks for being here. First question, we've been hearing a lot this morning about the feeling is amongst everyone that by May 31st, we're going to get this act wrapped up. Would you concur with that assessment?
Mr. Chairman, Senator Guru, yes, that is the date that we are working towards. The information has been with us to complete our audit, and we are doing what we can to make that deadline.
Thank you. And to follow up on thanks for your 6 recommendations. I wanted to kind of key on number 3, your staffing quotient. You've been in Cheyenne for a while and working with this account for a while. And you know the staffing levels we have now and the ability of us to, I know in your office to get people. What do you think our chances are of getting the number of people that we've got 5 positions coming in? We've got some positions right now that I know we're still trying to fill. With the marketplace the way it is, what do you think our chances are? And what could we do to enhance our chances? I guess would be the most important thing.
Mr. Chairman, Senator Guru, that is a very true statement. The resources available in the accounting and investment industry right now are extremely competitive. It's all industries are struggling with resources, but I feel we are feeling those same issues in public accounting as well. I think that from my perspective, some of this work can be done remotely, and so the Treasurer's Office may need to consider potentially creating some remote positions. While all of us love living here in Cheyenne, Wyoming, it is not always the destination for some of these people who have the qualifications that we're looking for. I know that in our accounting firm, specifically, especially since COVID, we've had to significantly increase the number of staff that work for us remotely in order to continue to retain them. Also, from the perspective of finding qualified people, salaries and wages have gone up significantly in the last couple of years. We're hearing anything from 15 to 20% raises annually to try to keep people in this profession. So it's going to be a challenge to be able to find the number of people that you need and at the level that you need them to perform at.
Okay, so, Mr. Chairman, I'm follow up. So, yeah, I think you're right on that remote work deal and the cost.
Mean like you're doing today?
Like I'm doing today, Mr. Chairman. Exactly. Yes, I'm out negotiating a contract for my business today, and I'm the only one I can do it, so I'm doing it remotely to you. Yes. I guess that's the last thing I want to talk about is this in-kind stuff and how much it's grown exponentially in the past 3 years. But that was kind of more our doing, wasn't it? We took this all in-house and we started to work with the system internally. And so, we were kind of the bringers of this onto ourselves. Do you think that we've got a pretty fair handle now on moving forward about trying to true that up and get to a place where we can get this more timely for you?
Mr. Chairman, Senator Guru, so again, it's the investment management team would probably be best able to answer that but from my perspective, I believe that they went into those transactions believing that it was in the best interest of the state to do so. So by doing those in-kind transactions, they were minimizing the investment fees that were being incurred should you do an actual gain or loss. And it was also keeping the money in the market versus having to sit out in cash while they did their rebalancings. So from that perspective, yes, that was a decision that was made internally. Again, I don't think that all of the accounting implications of that decision were understood at the time, and it's continued to evolve over the last couple of years. Moving forward, I don't believe that the accounting for those in-kind transactions is going to be any easier than it has been in the past. Again, currently the approach that's been taken is that once a manager liquidates, at that time, the Treasurer's Office will do a correction to recognize those in-kind transactions that have been previously eliminated from the ACFR into that year in which the investment manager liquidates. And so all of that activity and how those amounts were originally recognized has to continue to be carried forward and memorialized until those investment managers can be liquidated. Now, normally that wouldn't present much of an issue. However, a lot of those in-kind transactions occurred within alternative investment managers because those alternative investment managers are very hard to liquidate. I mean, that's the whole point. The whole reason you get into them is they have much longer term maturities. And so some of those investments may not liquidate for another 10 to 15 years.
Thank you, Mr. Chairman. Thank you, Brandon.
Okay, wait a second, I think Representative Overmuller was next in line.
Thank you, Mr. Chairman. Just for the committee's benefit, can you talk to us about the independence issue within your firm and the limitations that places on your ability to just go in and fix things from your perspective?
Yes. Mr. Chairman, Representative Obermuller, so we are required to abide by independence standards by both the AICPA as well as the Governmental Accounting Standards Board. And we take those independence requirements very seriously. We have numerous internal policies that we abide by to make sure that those independence standards are complied with. Representative Obermuller, to your point, we are not allowed to make any management decisions. And so, for example, with this unreconciled investment income issue that came up, while we can certainly identify that there is a problem, originally where we got to was we were nervous that we may not be able to opine on the individual financial statements. So obviously, we felt comfortable that we could get to a place from a materiality perspective that we could say that investment income and investment cash was materially correct across the state as a whole. However, because of the state's very complex investment structure, where you have multiple pools, and then those pools go to different managers, and then those balances get allocated across the funds and the fund classes, determining whether or not the recognition of that income by each of the opinion units within the ACFR becomes much more complicated. And while we can make recommendations, we cannot make those decisions. So whenever we find a misstatement, we present the misstatement to management. We oftentimes will work with them to determine how to correct the misstatement, but ultimately the correction of that misstatement and how it is corrected is the responsibility of management, and our responsibility is to opine on whether that correction leads to a materially correct financial statement.
A follow-up, Mr. Chairman. Okay, thank you for that explanation. I want to go back to your use of the term opinion units. Would YDOT be an opinion unit?
Mr. Chairman, Representative Obermuller, YDOT is what we refer to as a component unit. So it has its own column within the financial statements of the state of Wyoming, but it has its own audit, and so it is a separately audited component unit that is individually presented within the ACFR. When I speak to opinion units, from an audit perspective, we look at all of the different fund classes that operate within the state of Wyoming. Fund classes that meet certain thresholds, meaning that they exceed a certain percentage of the total assets and total revenues of the state, are qualified as what are called major opinion units. For those major opinion units, we are required to audit those units' activity specifically on an individualized materiality. So for the state, your opinion units include fund classes such as the general fund, the common school fund, the permanent mineral trust fund, workers' comp, unemployment, the foundation fund, the CARES Act fund, and then larger opinion units. Everything that's not within those are opinion units for non-major funds. And then ultimately the largest opinion unit is the entity-wide opinion unit for the state as a whole.
Mr. Chairman, yeah, thank you for that. That's interesting information that I did not know. Do any of the opinion units take their information to an accrual basis?
Mr. Chairman, Representative Obermuller, it's my understanding that the state in all facets operates on a cash basis throughout the year, and that the accrual to cash conversion only happens subsequent to year end.
Mr. Chairman, would it make sense, we talked about this earlier in terms of the Treasurer's Office, but would it make sense for that unit to take their information to an accrual basis?
Mr. Chairman, Representative Obermuller, that is a big question to answer, and one in which that would need a lot of consultation with both the Treasurer's Office and the Auditor's Office. I would get concerned about having a portion of your books be on an accrual basis, whereas the majority of the rest of the accounting would be on a cash basis. A lot of the accruals that are done at the treasurer's office relate to things that Aaron Benskin spoke to earlier, such as July income, June income that's posted in July that needs to be accrued back. Trade receivables and trade payables are accrued at year end. Securities lending transactions are accrued at year end. But for the most part, if some of these other issues can get resolved, the in-kind activity, the reconciling of the investment income activity on a more frequent basis, I think that those will have a much more impactful resolution to getting the audit completed and more timely information out to everyone.
Mr. Chairman, so the process should be that the treasurer's office actually calculates those accruals. They may not book them, but they calculate what they should be. They pass those to the auditor's office for inclusion in what I used to call the CAFR. Now it's the AFCR, I guess. And then it comes to you. Is that how it should happen? Is that the actual accrual numbers themselves are generated at the treasurer office level?
Mr. Chairman, Representative Obermueller, that is correct. So currently the treasurer's office, they need approximately 3 months because of the delayed reporting by the alternative investment managers. A lot of that information goes to RV Coons and doesn't come back in a final format until the end of September. But they do utilize all of that information, the treasurer's office does, to accumulate what information needs to be accrued back to June 30th, and those are the entries in the activity that are provided to the auditor's office to record in what they refer to as their engagement software, which is their financial reporting software. And then simultaneously, typically, we get that same information for audit.
Okay, thank you very much.
Mr. Vice President.
Mr. Chairman, I want to go back to your recommendations on number 5, and that was reduce the manual entries associated with part of the workload. We've heard this before, but it was interesting when you went through the chronological history of the reconciliation, and we continue to see a higher amount of dollars, but it's also, as you indicated, associated with more internal trades, more complexity, a lot of these issues going on. But specific to reducing the manual entry, this is a reoccurring theme. You've identified the problem and recommended, but is there, in your experiences, are you aware of programs, software firms that we can help get the state treasurer's office up to get rid of these manual programs? Is this something that you guys look at, that you actually have, while you've recommended we do that, is there programs out there that are standard and can do this for us?
Mr. Chairman, Senator Hicks, I have had the pleasure of being able to sit in more meetings recently with the treasurer's office as they've worked with some of their vendors to answer that exact question. And it's my understanding in conversations with not only these vendors that work with entities across the country as well as other accounting firms, KPMG and RSM, that the state of Wyoming is very unique in its investment policies. I don't know that you'll find another state that has 10 pools that allocate its investment managers across into multiple different opinion units. So I don't believe that there are accounting software packages out there that could meet the needs of the state treasurer's office, which is why they're working with Broadridge to do a customized package.
All right, thank you.
Go ahead, Representative Schwartz.
Thank you, Mr. Chairman. So I'm curious if you have other clients that use in-kind transfers, because both the treasurer and yourself has recommended we cease using them. And I'm looking at Mr. Fleming, and I'm guessing he thinks it's a advantageous investment mechanism. So are other clients you have able to do this without the accounting problems?
Okay.
Mr. Chairman, Representative Schwartz, so you're right. Patrick Fleming would not have undergone this if he didn't think that it was beneficial to the state of Wyoming, in my opinion. Obviously, there was a reason to undergo these transactions, and we've had significant discussions about how much more difficult it is going to be for his office to do rebalancings going forward to stay within the guidelines of those investment policies. From an accounting perspective, if the state of Wyoming had one opinion unit and it was one legal entity and we only had to opine on the portfolio as a whole, doing those in-kind transactions would not pose any problems at all. The issue comes in that each investment manager holds a piece of its investments that may belong to the general fund or the permanent mineral trust fund or the workers' comp fund. And so by continuing, when you, like I said, when you start with the 10 pools and then the 56 managers and then the 80 opinion units, to get down into that level of granularity, essentially, if you are going to say that this investment is owned by this opinion unit, you can't effectively trade it to another opinion unit unless you have really had a realized gain or loss from an accounting perspective. And so that's where the complexity and the problems come in.
So in other words, the opinion unit that is the seller is entitled, if it sells for a gain, it's entitled to the gain and entitled to the recognition and the benefits associated with that side of the transaction. And that's what's not happening.
Yes, Mr. Chairman. So essentially, even though internally the state may say, well, this share is owned by PMTF and we want to sell it to the general fund, from an outside perspective, from JPM's perspective, no sale actually occurs until that's sold outside of the state of Wyoming.
Yeah, so like I say, they'd actually have to be a sale between the two units of
If
some sort.
They would have to be separately legal entities within the state of Wyoming, yes.
Yeah. Okay, anything else? I do have one quick question for you. Just since you raised up, since we talked a little bit about the independence, in the attachment A from the Treasury report, there's a statement from the Treasury Office. So we determined the worksheets we had been using to satisfy the audit requirements for manager income and bring back were not adequate to meet the request for the auditors. So STO started using the report MHP created for the manager income reconciliation during FY21 in an attempt to eliminate duplication of effort by STO and MHP to get ahead of the audit. That doesn't create an independence issue for you if they plagiarize one of your worksheets, does it?
Mr. Chairman, no, it does not. With that comment specifically, what we identified beginning in fiscal year 19 and fiscal year 20 is that the reconciliations that the State Treasurer's Office had been doing internally were not designed to find some of these issues that in these transactions that were being done currently. But from an audit perspective, while we looked at the State Treasurer's Office reconciliations, we prepared our own reconciliations to ensure that theirs were reasonable. And in the course of doing so, we're able to identify some of these issues and felt it appropriate to share those reconciliation templates with them so they could use them internally.
Okay, so everybody's still producing their own information or just using the same template so you can get to the same point, hopefully.
Mr. Chairman, correct. And we removed any audit documentation that we had within those work papers prior to providing them to the Treasurer's Office.
The other question I had for you was, what occurred? So there were discrepancies between the income distributions and the JPM income reporting, and in prior years they were able to combine that into one net journal entry, and then as I understand the discussion today, that expanded significantly this year, and so we had to break that down into each of the individual, I guess now we're calling it each opinion unit. And so what changed there? What was the impetus behind that differentiation between 2021 and the prior year?
Mr. Chairman, so as Katie testified earlier, we did work collaboratively with them, and our recommendation was that each of those reconciling differences by manager be recorded in their own journal entry. The reason for that recommendation was that, again, as these transactions continue to cross fiscal years, we essentially have 3 books of record. You have JPM, you have Wolf's, and then you have the ACFR. And those transactions are reflected differently in each of those bodies of information. And so the intent was that if those correcting transactions were recorded in individual journal entries, then let's say we have one investment manager that was off $20 million. And the treasurer's office is able to work and get that correction into Wolf's in May of 2022. From an ACFR perspective, we will then be able to use just that one journal entry to reverse that transaction from a financial statement reporting perspective, because we will have already recorded it in a prior financial statement. So it was really about trying to facilitate the correction of these errors moving forward, because while they've been corrected in the ACFR, they still have not been corrected within Wolf's.
And then, which brings back to one, I think much of my last question, that was, we had some of the same, just as we went from year to year, is part of that the reason that in the end, did we end up pushing forward some of the same issues from last year into this year? And so by doing this, that will help us stop. So we're starting from a clean slate each year as opposed to kind of morphing that in, and we don't necessarily start at the same place moving forward, if that makes sense.
Mr. Chairman, in our discussions with the Treasurer's Office at the end of March, when the investment and reconciliation was completed, it was my understanding at that time that the majority of those corrections that had been identified were going to be made in Wolf's before June 30th of 2022 to prevent that perpetuation into future fiscal years. I do believe that it will be challenging to make sure that all of the corrections that are made in Wolf's are subsequently corrected within the ACFR by making sure that that activity is essentially eliminated, because we would have made those corrections via journal entries in the prior year's audit. But it's my understanding that the majority of those reconciling issues from prior years are intended to be corrected in this fiscal year so that they will not impact future fiscal years.
All right, thank you. Any other questions for our friends from MHP, MHP? All right, thank you very much. Appreciate your time today.
Thank you.
All right, so we're in about 20 minutes behind. Why don't we take a quick, I think it's time for some people to go and take a post-coffee break. So let's go ahead and we'll go ahead and we'll come back here in like at 10:45. That's about 8 or 9 minutes.
So we'll start at 10:50.
JAC stretch. Hey, Representative Larson, glad to see you. At Karen, whose cafe? Oh. You know, I've done that where supposed to meet in Casper, drove down here for the meeting, had to turn around and hightail it back to Casper. So you pulled a Perkins. You pulled a Perkins. Yeah, been there, done that. And it was CapFin too. Yeah, I drove down here for a CapFin meeting that was at the Oil and Gas Commission once. Yes. Got down here at 8:30 and walked in, nobody's around. I walked up to LSO, I says, where's the CapFin meeting? He says, in Casper, you idiot. I made it, I was back there by, 11, yeah. All right, we'll go ahead and call this back to order. Hey, Senator Guru, are you out there still? Senator Guru, are you out there?
Mr. Chairman, I'm looking at his camera and it appears he is not available at the moment.
Okay, I was just gonna tell him he needs to butt in so you don't have to walk over and hand me a note when he's up there, since I'm actually looking at materials for today and not watching the screen, so. Senator Gru, if you're out there, you need to speak up. So anyway, we're back, and thank you, anyway, we're continuing on. Next, we're talking about, we've already started into some of this, but the Treasurer's Office organization and status update on how things are going there. And we've already started to talk about some of that, but we'll move forward on specifically about that. So Mr. Treasurer, you and whomever from your team that you want, come on down. She's behind you. You thought she ran out the door. You said, wait a second. I saw that look on your face. I've had that look before. Yeah, I've got my best people here. Well, I had my best people here. Go ahead, Mr. Treasurer.
All right, thank you, Mr. Chairman. Everybody hear me all right here? Okay, so the CLA report, I think the long and short of it is that we're making great strides on this. We really are. And the reason we wanted to get CLA there, and the first thing is because we knew that there were some, I guess, challenges in the office, and we wanted to get some input to see if we would essentially try to do it right the first time, and we're moving down that road. So essentially, we got 3 positions in 2021. We put those in, and that.
All 3 of those, you got all 3 of those filled now, or?
Yeah.
Okay.
Yeah.
Good.
Yeah, and they're I guess I would say working well, and of course, as Katie mentioned, that they're kind of an office reorganization, so those folks will still be in those positions, but we're adding a whole other section with another lead person to run the other division. And we're going through and doing our skills and our cross training. We did a lot with. I guess one of the first things, and it's not on here, is that in the skills thing, the accounting team didn't really speak investment language, and so we had a seminar basically to have the investment team really kind of go through and give them a good primer on investment language, and that worked out good, I think, with the level of skill that we had to start with. But the guys and gals in the accounting team now, they understand this stuff forwards and backwards. And the CIO and our whole office, basically every 2 weeks, we have a division sit down and everybody explains what everybody else is doing. But there's good communication on a daily basis, and in addition to that. As you remember that the big thing that CLA said was system, processes, and people. And so we're moving forward on the systems. We went through and figured out our IT architecture and what we wanted there. We tried Clearwater for a while, but they couldn't move forward in the manner which we needed, and we've brought on Broad Ridge. There are basically they were QED. It was bought out by Broad Ridge, and so they've got a good understanding about what we need. And the complexity, and this is where we lose most people, is when you tell them that you've got 10 funds and you've got 50-some, 60 managers, and each manager may have 3 or 4 funds, or they may have 6, or they may have 2, and all the funds are commingled. And we have to have do a planned sub-accounting. The number of people that do that they're just almost non-existent. I recall a story that Patrick told me that they went through, and I think the Governor Gordon, then treasurer, said that they went through, 17 or 23 different people that walked through their door. All of them, the first thing they said, "Oh yeah, we can do it. Our software will handle this." And by the time, in about a half hour, an hour, their eyes glazed over and said, "No, we can't do it." And the same thing happened in middle office. As you can see here where CLA said that Chase has a middle office and as a service, that was where CLA, I think, dropped the ball because it's just not available from JP Morgan to investment operations like ours. But Sam Masudi asked me to take a look at some folks, and myself and Don, and I think Matt sat down with them, and we told them the same thing about how complex it is, and they said, "Well, no, we can't do that. Yeah, it won't. We just don't have that capability to account in that detail." So I think that Broad Ridge is really making a stride, and they were they're one of the people that could actually do the distribution beforehand. So we feel pretty comfortable that they can account in that detail. It's going to mean a lot to what we can do. I know we talked about the possibility of unitization or different structure. And one thing that Broad Ridge did tell us is that once they get implemented, and it'll take probably to the extent that they get everything in there, it's going to be several phases. But they said once they do it, that they can actually unitize on a dollar basis. So we're looking at, for the next biennium, that's something that could maybe actually be a possibility, which would take us out of some of these different areas where the accounting is extremely complex. It might reduce some of the complexity. But of course, what our new mantra is basically let's measure twice and cut once. And so it's essentially, we're going to make sure that however we move forward on these things, that we bring in all of the players and make sure that we're moving in the right direction so we don't stub our toe. So the data analytics, that should go into the system as it's built out. And I think that's going to help us a lot in preparing the reports. And what is it, Don? Do we have 37 reports that we have to repair? Is that what it is? Yeah, I think there was, just between statutory reports and other reports, so there's a lot of things, and we're hoping that what we can find out is that once we get those data analytics and the reporting capabilities, which I think is going to be fairly substantial by this system, that we can get some of those unified. So They can go online and you guys can get from them anything you want to, basically every month from our website. So, and anybody else too can do the same thing. So that's basically what we're doing on upgrades. Now, one thing CLA did is they went a step further and they recommended some organizational framework and some governance. They did have a caveat that they weren't going to look at any of the statutes or the Constitution or anything else, that they were just going to make some recommendations. And so the ones where we're kind of halfway in between is I guess the alphabet soup were the COO, and we've pretty much fleshed out the job descriptions and job duties. It's fairly broad, but we don't expect that there's any one unicorn that's going to walk through the door and be able to do all of the particular job duties. And we'll just have to see what that $250,000 will buy. The IFC voted unanimously, in fact, consistently unanimously, that we use a headhunter in that process. Because that just they're just adamant that that's the way to get the best people there. I know being on the WRS, for the longest serving member, I've went through 3 processes of executive directors and CIOs, and using headhunters in each one of them, and that really made a big difference to the quality of people that walked through the door. Going on to the what they looked at there was to establish an instrumentality, and I think instrumentality was probably one of the words that I pushed them toward because of the WCDA and their instrumentality. Another other independent legal entity to manage the investment portfolio. And, that's, you guys, I think, know where I'm at on that. The State Loan Investment Board would continue to set investment policy. However, to provide effective governance, we recommend establishing a governing board with board responsibilities and committee members who have experience and authority to oversee. The first 4, that's what the Treasurer's Office is pretty much doing right now, and that's compliance with the investment policy, overall investment management, legal compliance, trade execution, settlement, operations and infrastructure, audit, accounting, asset evaluation, and reporting. And I believe that we're on the road to doing that quite effectively. Notwithstanding today and the audit information that we heard, we are moving forward with our Broadridge, and we're all moving forward with our operation system as far as trading in Bloomberg. Those things will be online, and I think the timetable which we've set forth, and the legal compliance. Lisa Jurdy Spillman is doing a good job making sure that we're under the legal compliances that we need there. And Bloomberg takes care of a lot of that, as well as JP Morgan, as far as things, execution and different things about how that's supposed to happen. And as you heard today, the audit and accounting, those are things that are going to be, we've got the people, when we get them in there, get them trained, which is going to be probably 6 to 9 months down the road, then that's going to be an ongoing process within the office. And the last one, personnel and compensation policies. There's some interesting things that I see in your suggestions about different ways to do that. And I guess when we get the governance, I would say we did bring you, I guess, an addendum to our stuff. And there's some specific stuff in there about Florida and Alaska. And the reason I brought those in there, I'll have you turn to the back here where we have the performance.
Which, can you help us with that? I'm not sure which handout we're talking about.
It starts out with, to whom it may concern.
You know,
And it was on your, and every one of you
So I've
should have
got-
had it. Yeah, Bob's got it there. Yeah. But turn to the back there. It's got some historical performances in there. And it does have our 2018 and 2021. And that shows you how in our 3 short years, essentially, this is the PMTF. Basically, we increased our return over that 3-year time period about 1.9%, and it's right at about $180 million more, and added another $5 billion in unrealized capital gains and of course contributions to all the funds across there. And I found it interesting that when Brandy from MHP was talking, that she went back to 2017 and it was 20 billion. Well, it was 20 billion when we got in there. So we did that in 3 years. But where I want to have you pay your attention to is the historical fund performance. And this is an excerpt from the HB 244 report from RBK. And the reason I brought Alaska and Florida is that in the 1-year returns, they were first and second. In the 3 years returns, they were second and third. And in the 5-year returns, they were second and third. And in the 10-year returns, they were actually third and fourth. Now, Idaho did well in all those other ones in the 3, 5, and 10-year returns, and that was essentially because of the bull market run. But the governance structure that Alaska and Florida employ is an advisory committee, and I think it's in Alaska, I think there's 3, and I think in Florida there's 5 people on the advisory. No, it's 9 on the advisory committee. And the politics in it is kind of interesting. Both those, and I'm not advocating this, I think we got a better governance set up right now as far as our selection process into the IFC. But in Alaska, the governor essentially appoints 2 and then appoints their 2 cabinet members, and then he appoints the other members to the committee. And that's given quite a little bit of problems in Alaska. I think you guys probably remember Angela Rodell that you may have met at the last Treasurers Conference. Essentially, it was so political that the governor changed one of his appointees, and she was basically down the road for looking at some optionalities in personnel and compensation policies. So that's extremely political, and it's extremely political also in Florida as far as the governor, who's the most political person there, has a great deal there. It's a different type of a structure though as far as the board. It's a 3-person board, which is made up of the governor and 2 other elected officials. So, but more or less like our SLIP. So
We're gonna spend more time on that this afternoon.
Yeah.
So we're trying, right now, before lunch here, we're trying to get into just the updates on the organization. You've taken us through the new people you've hired. You talked about the CEO. There's some other updates we wanted. So we're trying to get the updates. We'll go back more to the 244 thing this afternoon, which that discussion will get, so we'll have better, so we wanted to go ahead and continue on with our updates in the organization and the status updates on the systems that we've been talking about.
On the details there, Don can speak to that, or we have Jeanette Beeman, who is the project coordinator for technology, whomever
Great.
you'd like to hear from.
Great. Dawn, good to see you.
Thank you, Mr. Chairman. Good morning, everyone. I'm Dawn Williams, Deputy State Treasurer. As you can see, I did provide in your packet our first of our monthly required reports on our workflow automation, it is termed. It's encompassing of our accounting software upgrade as well as the implementation of our order management system. We have been working on implementation of both of these systems simultaneously since January. The second monthly report came out earlier this week, and we also provided that to you with physical copies and online through Karen. Essentially, the first one I'll talk about is the upgrade. You've heard about it multiple times this morning from our QED software. We call it B2 to H2 or something. And so I did bring Jeanette in case you had any technical questions that I couldn't answer, but essentially we're doing that project in 3 phases, if you've heard that before. Our first phase will go live on July 1st, and as Katie mentioned, we start our parallel process. Basically, when you design the system, then you have to test it. And we've been doing the testing, and now we want to test production versus the way we have been doing things. We want to parallel to make sure that the system is encompassing everything that we imagine that it will. And so that begins next week. And the team is working very hard to do this. Because we have fiscal year end as well as biennium year end, 2 month ends in there. So so our time is very well mapped out, and we are confident that we will be able to implement phase 1 on July 1st. That did require quite a heavy lift of our chart of accounts and general ledger. We're just upending the whole thing, the way we do things, because it is antiquated. And as you've also heard alluded to, our system was from 1996, and our business is clearly not the same as it was in 1996. So we've had to make a lot of adjustments to accommodate that, and it's just going to make life so much easier in so many ways. And that does include the automation of information into the system. Right now, as you're aware, we operate with a number of spreadsheets, and they do require that information coming in individually into spreadsheets, or they're linked. And if you've ever linked spreadsheets, that can go haywire in a New York minute if you've add a line or move a cell or something like that. So there's a lot of work that goes on, and to the team's credit, we operate efficiently with those spreadsheets. It's going to be it's just going to be a game changer with this new system. So that's on board. The next system that we're implementing is our order management system. This is automated in our trades. And this, we actually are moving along with that. Last week, we had training for our middle office, our operations unit within the accounting team. And then they'll be back next month. Bloomberg is our vendor. They'll be back next month on site again to do the training with the investment team. I think the second week of June, they'll be here the whole week of June. And so then we've kind of scaled our rollout of the OMS a little bit, because like I was just saying, we have our accounting system rolling out. We have month end, fiscal year end, biennial year end. So we have to slow down OMS. We just simply can't implement that at the same time that we're doing those other things. So we've adjusted all of our schedules. Jeanette's a great planner and coordinator. This is her wheelhouse, and she does a great job. And so she's got us on our plan. And then when July comes, after the end of the year, we'll be back rolling up on OMS, and that is scheduled to be implemented middle of August 15th or 16th. So we'll go live with that. The next thing that isn't necessarily workflow, but that is also included in your report, it's the KPMG, our contract with the accounting firm. We did, as been talked about this morning, contract with them end of January, early February, to try to help us with this manager reconciliation issue that we're having. It's taken them quite a little bit of time to get up to speed, as it always does when we have a vendor, because of the way we do business. It's just not a cookie cutter. We have to do, Katie spends a great deal amount of time explaining our business and how we do it KPMG initially was like, we really just want a map of how the information that you provide to the auditor's office goes into the financial statements. And we said, look, we give it to them. We don't know how it goes into the statements. Let's ask SAO. SAO says, well, we put it into our engagement software, and by golly, we get a financial statement. There's a little frustration with KPMG on that because they really wanted a map. And so they spent a lot of time. They really are focused on processes and mapping. Where does our information go? And Brandy spoke about this morning. Yes, overall, all of our cash balances and overall, we reconcile. We know what's income and what's not. But it's that granular level of detail and the materiality of those individual manager reconciliations that that required us to do that extra work. And so that's what we needed KPMG to jump into. And they have been working to do that. They are trying to map those same processes that Lisa spoke about, that we're working with our managers as well as our custodial bank, trying to say, what is the level of detail? What is the level of information that you require in order for us to be able to get the information that we need? And to try to sort of standardize that a little bit as much as we can, full well knowing that the managers are different. That's one of the things that I think KPMG has struggled with the most, is it's different. Each manager is different, each fund is different. So anyhow, that's what they've been doing, and they've been a great help to us, and they're gonna speak to you a little bit later as well. We intend to keep them on with us and to help us with any issues going forward, as well as those journal entries that we were talking about this morning that we traditionally have not prepared, that the state auditor's office has actually prepared those in prior years.
So Dawn, going back, so on the phase one, which I think that's the one you're going to go parallel on here, starting, was it next week or the week after?
Yes, Mr. Chairman.
So help us understand, what is it that with the workload in phase one, what is that going to do for your office? As far as are replacing spreadsheets? Help us understand what phase one and what going live. We say we're going to go live and go parallel. What are we going to parallel, and what will that help us just understand that a little bit better, please?
Okay, Mr. Chairman, I think I'm gonna phone a friend, and because Katie will be able to tell you what those specifics are. Do you mind jumping up here? I know, so I'll just leave it at that.
Hi, Mr. Chairman. So the advancements that we're going to get in this first phase are going to be a complete revamp of our chart of accounts. So that the way that we have it structured currently is going to be changed in a more standardized, efficient way, so that we can actually start feeding in JP Morgan data directly into the system. So it's that first step. We have to have the foundation set.
Okay, so when you have the chart of accounts, and what you're doing is just basically what you'll have is you'll have JPM, but then you'll continue to feed your items from your spreadsheets into there, and then ultimately that chart of accounts, you're going to start posting to your chart of accounts so those reports start to come up.
Absolutely, Mr. Chairman. The end goal in phase 2 and 3 is to be able to utilize the JP Morgan data to be able to auto post using the new chart of accounts. That's in phase 2 or 3. In phase 1, we're going to be using the new chart of accounts and automating how we post currently, so that we lay that foundation and we're ready for that data feed from JP.
And so when we do that, I mean, we're starting to go parallel, but we're in the middle of the fourth quarter of the fiscal year. How's that going to work with the fact that, I mean, we've got a half or 3/4 of a year that are not under the same chart of accounts?
Mr. Chairman, you're exactly right. It's not ideal, but in order to be able to go live July.
Start somewhere.
Exactly. It's not ideal. I mean, I am a stickler of having like a quarter of time to parallel something, but obviously we're up against a time frame and we need to get something kicked out. That's why this is in a phased approach. So it's more tangible. We're taking one bite of the elephant at a time. We're not trying to change everything on July 1st. So I think it's going to be somewhat of a again, a phased approach, systematic approach to changing all of our processes and
And
systems.
the idea is that parallel now, by the end of you got to, at least got a feel for it by the end of June 30. And so as we go into the new year, that you'll have a standardized chart of accounts for all of fiscal year 2023.
Mr. Chairman, that's exactly right. We go July 1st, go live with the new foundation, the new chart of accounts. We also are working on business process improvements. So we're utilizing the system to replace some of those manual spreadsheets. So a lot of that work is coming straight out of the system currently, but we have to pull it in and manipulate it and twist it and then slap it into a spreadsheet to be able to report it. And instead of doing that, we're working with Broadridge to automate that process by showing them the map of what we're doing on our spreadsheets so that we can use their extremely advanced reporting tool to be able to spit out those reports as well. And that will be part of our parallel process. We're only doing a few of them, right? One bite at a time. We're doing a few of them right now, some of our most needed at this juncture. And then those will continue to build in phase 2 and 3.
Okay. Go ahead, Representative Larson.
Thank you, Mr. Chairman. Dawn, I need a little help. Is you provided, excuse me, you provided this information to us because we requested it through a footnote. And for me, it's very helpful because, you know, a lot of this I don't talk that language that you do. But when I have this report of your schedule, doesn't matter if we're building a software system or building a building, it kind of lets me know where we're at on the schedule. And that's kind of what you've tried to provide here through attachment A and B. So if you go to attachment B and C is what I meant. You go to attachment B and C, we have a start date, an end date, and status. And so those that we have a start date and an end date and it's complete, that's pretty self-explanatory. But I don't understand is when we get down here and we have a start date, like under the hydrogen UAT zone, we have a start date of 3/15 and end date of 3/28, and then it says in progress. I don't know what that means. So I don't know when it's going to be done. So I don't understand. What that tells me is we're behind schedule, but I don't know when it will be done. So what are we doing to adjust our schedule? And when's the new end date so that we know it'll be done? Certainly we hope it's in progress, but what's the end game here? And then you go down a little further and you just have blanks over there on status. We've got a start date, an end date that tells us it should be complete, but we don't know if it is complete.
Mr. Chairman and Representative, so the packet that I provided you, the original was April. Okay, so I've given you an updated one this week. So you'll see, in April, as of April 15th, when I provided, and there's a start date of 4/18, it's blank because it hasn't been started yet. So that's that in that case. The ones that are in progress there were some things that were delayed. We had it delayed because we had a problem with getting our information from JP Morgan, the data conversion into Broadridge. And that significantly did delay the process in between I'm sorry, that wasn't your question.
We understand that, but we can't draw those conclusions from what you provided.
Okay.
And so when you say a start date and an end date and we don't meet the end date, then what's the new end date? We realize, I don't know if you had weather days that you couldn't work or materials didn't show up or it was too muddy. I don't know what it was, but what's the new end date to make sure that we get back on schedule was kind of what I was looking for. And then when you go over to your attachment D from KPMG, we talk about on page 2 of that report, we have item number 2 as reconciliation of source mapping in progress, but then you go to the next page and all the source mapping shows that it's completed. So is it completed or is it in progress is what I was trying to figure out as I read these scheduling things. And so just having an accurate understanding of these spreadsheets helps me at least to understand where you're at in your schedule in building whatever it is we're building. And I hope you can see where I'm getting confused.
Mr. Chairman and Representative Larson, I think that it's confusing when you're not in the project, and I can understand that. So there were two process flows that KPMG has been working on. One was, again, the ACFR process flow. How do our numbers translate to financial reporting? That is one that they feel like they have completed at this juncture. The other one is for the income reconciliation process. How can we improve that process to eliminate issues going forward? So I think there's a couple different process flows that are being referenced in this.
Okay, so on the KPMG, Mr. Chairman, to the KPMG report, on page 204 there, where it says item number 2, reconciliation of source mapping. Am I then mistaken if I go to the next page and draw a conclusion that 2.1, 2.2, 2.3, and 2.4, 2.5, and 2.6 then are unrelated? Or
No.
are they related?
Mr. Chairman and Representative Larson, they're absolutely related. Not all of the components are there. So they've parsed out all the pieces in the completed section of the total 2. So they're saying of 2, we've completed part 1, part 2, part 3, part 4, part 5, part 6. But that's not all the parts to be able to get 2 complete.
And where would I find that list?
Of what's not completed. So we started they decided that they were only going to show completions. They weren't going to do the not completed. But we have started working on a new status report where we're going to be getting the not completed, what is still outstanding pieces.
But then I would, Mr. Chairman, I would conclude you realize how it's hard for us to track that if we don't know those details, right?
Mr. Chairman, can I just jump in real quick? Thank you very much, Representative Larson. It's great to have the feedback. It's a brand new report. We'll take your suggestions.
Thank you.
Thank you.
Yeah, I'm not trying to be critical. I'm just saying
No,
I
it's great.
can't draw the right conclusions with what I have.
And Mr. Chairman, again, brand new report. Sometimes, for instance, we send those monthly distribution reports. I didn't realize, I had never received any feedback about those until I heard testimony during the session, was able to revise those reports. It's great to have the feedback and really appreciate it.
Thank you.
Okay, thank you. Go ahead. Go ahead, Representative.
Thank you, Mr. Chairman. Don, did KPMG have access to the auditor's office in terms of their mapping and key workbooks that tie to the after? Did they, it seems like that's where all this mapping would reside if they had
Mr.
access
Chairman?
to that.
Yeah, Representative Obermiller, we were advised by SAO that they did not have mapping to provide to our KPMG.
So your testimony is no one had mapped this.
Mr. Chairman, SAO did not provide us, I can't speak to whether they have mapping and didn't give it to us. If they don't have mapping, they declined to help participate.
Yeah, Mr. Chairman, I'm just kind of curious how the auditors dealt with that, the absence of that mapping when they were looking at internal controls.
Mr. Chairman, Representative, I don't know.
Thank you.
Mr. Chairman.
Go ahead, Representative Larson.
Thank you, Mr. Chairman. And Katie, you might just go talk to your dad. He's the one that taught me to look at these. Okay.
Mr. Chairman, Representative Larson, I was getting the mud and the weather days and the material. I was hearing it, yes.
And then the other thing that when you get to attachment C, which is the order management system, and what I understood from your testimony, I mean you made a lot of progress on that, but if I understood your testimony right, that's going to get delayed a little bit because we got to prove up the first part, the chart of accounts and how that's working. And so one of the things that'll happen there is obviously, on attachment C, there's tons of that's already complete, but I guess in some respects, the stuff that's not complete yet may be on hold for a little bit until we do get the parallel going and the prove up in the chart of accounts. Is that right?
Mr. Chairman, the chart of accounts and that is part of the accounting system and not related to the OMS. So what Jeanette has done with our dates is establish them according to our ability to be able to be participatory and make those dates. There will be a lull in the OMS project. Not, as I stated, the investment team will be training on site, but as far as the accounting team involvement, there will be a lull during June, and that is accommodated for in the schedule.
Okay, and that was really what I was getting to, was as I look at attachment C, does that have the new end dates in it already
Yeah,
for
yes, Mr. Chairman.
the anticipated lull?
Mhm.
Okay,
Yes, Mr.
all right,
Chairman.
thank you.
All right, Mr. Chairman, thanks for all those questions and the good feedback on the report. The next thing that we were asked to talk to you about is, or provide some updated organization charts. And we did do that and in our packet, and those are on the last two pages, pages 22 and 23. The request was to provide a chart from 2019 and one in May of 2022, presumably to see the growth that we've had. In a nutshell, we've gone from 33 to 45 employees, which is a 36% increase. We have currently 8 vacancies, 7 of which are from and I'm talking office-wide, not just accounting, but so 7 of the 8 are the positions we received in March, 5 accountants, the COO position, as well as 1 legal assistant position. The 8th position is an accountant, which has been vacant less than 1 month. So we have those 4 that are advertised now. 3 of those new accounting positions were effective immediately. We've had good luck with the 10 position. They're classified as, levels 10, 11, and 12. We have had some good folks for 10s. I know this is repetitive, but my concern now is I have revamped all of our job announcements. I have pushed out on social media. I've done a lot of different things because I'm the HR lady now, so I've been doing all these things. And so I've been reworking all of the things that we do to try to attract people. I'm starting to worry that that the pay is a factor. I mean, we do not pay even at the median of those class codes, but the median is advertised, and I'm still not getting any response on those upper level positions. Luckily, the folks that do respond to these applications are really good. I think we have some good prospects for those 10 positions. I'm just not getting any results on the upper level ones. And the way I've written the job descriptions now, with the blessing of Katie and my staff, is that, hey, listen, investment accounting isn't the norm. We don't learn this in college. Because that's my background as well. There's none of that. Even governmental was municipal government, not state government. You just don't learn that. So hey, come take everything that you've learned, all those skills you have, and come work for us. We'll teach you the investment accounting part, as long as you have those basics. But they aren't basics, like Brandy said, that a college student, not those kind of basics. I need somebody who's actually done some accounting work, actually understands how to apply what they've learned. And I'm still not, I think I did a really good job writing those job descriptions. I'm still not getting any feedback. I think it's, and I fear it's the pay. So that's just my 2 cents about that. You also asked about compensation changes from 2019 to present. The Treasurer's Office has made 8 salary adjustments in just over 3 years since the Treasurer took office that were did not pertain to statewide compensation adjustments. 2 of the positions we reclassified in 2019. The Treasurer came in and assessed what his needs were, and 2 of the positions that we had were reclassified at that time. The rest of 5 of those positions were adjusted to avoid compression inequities. We had somebody in the same class code making significantly more than another person. We evened those out. And then 1 adjustment I made as a retention measure. Our IT person was offered a job with the feds at a significantly more than I could pay him. And I came back and said, hey, would you take MPP, which is the median? And fortunately, he did take that. That means that I have to make adjustments in another position where I can't pay a person as much that they are budgeted for. I have to make those adjustments within my budget. And I would like to say that it's important to say that every time that we do these changes, we have to have them approved by A&I and the budget division, because no salary change or classification of an employee can be made without their involvement and their approval. And we've subsequently come to you, the legislature, and say, hey, this is what we did, this is how our budget is, and it's all done transparently. We also never exceeded our appropriation for salaries per the budget requirement. And so that is that report. And I think that was the final thing. I'm just looking at the final things that you asked for. What have I missed?
I think that may lead into, we've got down here plans or status on outsourcing, accounting, and other functions. So how does, that may tie into what you just spoke about. Have you, I know we've had some informal discussions between the treasurer, you and me, and I think that the chairman about that, and I know you guys have been kicking that around. What are your thoughts now about outsourcing versus some of the other things we're trying to do?
Mr. Chairman, as far as outsourcing, all I'm aware of is the fact that we are interested in retaining KPMG to assist us as we progress through the next fiscal year, especially during the audit process, while we're attempting to fill these positions and get them trained. I've never considered outsourcing the accounting functions of the office in whole, if that's what you're referring to.
Okay, thank you. All right, any other questions for Don? Any questions for Don? Okay.
Yeah.
So,
Go ahead, Mr. Vice Chair.
just a couple things. What, and I talked about this a little bit earlier, Don, but what we need, I think, going forward is to know all of these additions that we're adding to in terms of employees and staffing, and how much we're paying them. And in terms of your accounting costs, anything and everything that's related to the investment team and our in-house investing. Somehow we need to, I think, reevaluate and categorize that so we know exactly what it's costing us. And going back to how Patrick used to present to us on the benefits of our in-house investments and what our total return is and our net return versus what it would have been had we not gone to in-house investing. So I think we have to revisit that, because every time that we have increased accounting costs, increased auditing costs, if we're going to have 6 folks in your auditing division or 7 folks in your auditing division, how much that will cost us on an annual basis over time so that we can continue to assess, are we doing the right thing? Does it make sense to do this the way we want? And then on the accounting, on our investment side of it, does it make sense that we have folks, trading on the US stock markets versus foreign stock markets and all the things that we do and that Patrick does? We have to account for it and say, we're doing it because we are helping the state make more money, total overall return, plus we're bringing expertise in and growing your office in order to accomplish all those things. And as you know, some of the folks on the IFC said, you guys are crazy doing this. You ought to just go to one of the large houses and let them do this for you. You'll get a better return, you get more insightful information on your investing. And so we have to be able to say, this is why we're doing it. These are the pros, these are the cons, these are the pros, and these are the dollar amounts. So I think we have the obligation to continually assess that on how we're operating. And so that we can be comfortable every time that someone asks us that question, or when the IFC meets and they say, why are you doing it? We can say, well, it's pretty simple. Here it is, here it is, here it is, and this is why. And it's a great thing. So
I think that would also help us, at some point we've had the discussion about, okay, if we allocate X number of basis points to your budget. And so, somehow we've got to back into, we got to see that's the right number, not, how do we know the Goldilocks number for basis points? If we need to understand the underlying expenditures.
Sure. Mr. Chairman, I've done that analysis. So I know how much we spend on investing, including our accounting and all the support costs for legal as well. and have translated that to basis points. So I've done all of that work. The thing is, the amount of accounting, there's a lot of focus on the internal investments, but that's a very small piece of what we do. The asset allocation drives the complexity of what we're doing in our office. And that complexity drives the number of people that you need to effectuate those things. And so to pull out one or two people because they trade internally, that's not, the team is, they also cross-train.
Yeah, we've got 50, 60 fund managers. Not
That's
just-
right, not just our one internal manager, which is our team. And so it's not that cut and dried. Of course, we have compared ourselves to other entities. Obviously, we don't cost as much. Even with the new positions that I built into here, I have done that analysis. And Patrick will speak to you a little bit about fees during his investment update as well. He'll also talk to you about how much money that translates into, and the fact that fees are not going to be not going to be indicative of what the contributions are given the asset allocation. Fees are going to go up, as he has explained to you before, because of the kinds of investments that we're making. And so I'll let my professional talk to you about that here in a minute. But it's not a one-to-one relationship anymore. It's just really changed. We can't do apples to apples. It's just not the same as it was in 2017 when we did the internal investment rollout. If I go back to those, maybe I can go back to those 3 people that we rolled out, but the people that we've added since then are all asset allocation, and that's where the money is.
Mr. Chairman, and in that regard too, it's kind of looking at there is that one subset of costs and expenses and returns, and that's the internal trading. But the biggest value that I see from the folks that are there is really in manager selection, because these guys are finding managers that aren't on RVK's best manager list. And RVK is excited to be able to take a look at them because maybe they'll end up on RVK's best manager list. So that's really where I guess the value add is coming with a lot of the employees now is in that area, as far as the due diligence that it takes to pick managers. And they're doing it, especially in the I guess the climate that we have now in down markets, that they have purposely, and this is through Patrick's leadership, has purposely picked managers that have a lower downward beta. So when you're in a down market, you lose less money. And they've done a remarkable job. Matt Schmagosh has been last year was nominated for turnaround of the year. And he was up against Delta Airline in Northrop Grumman, I think it was. And so he went from 7.2% to 37 and 39% in privates. They're just an amazing group of individuals that bring skill sets and relationships. So it's kind of the whole thing. And one way to look at it is rather than basis points, sometimes might look at the alpha that they actually generate, because they've beaten the benchmark the last 2 years and probably do it this year. So that's another way that you can look at as far as of the value that they bring in paying for the investment you guys have made.
Okay, thank you. So, anything else, Don? Go ahead, Go ahead, Representative Hart. Go ahead.
And Deputy Treasurer, just really, I wanted to we're facing it here in so we started a course at University of Miami, all strategy, that pipeline law, introducing them to this whole governmental law, and I know that the investment division, they have, I think you have the terms, and I'm just wondering, do you have those opportunities for like accounting pieces? Maybe there's a class that you guys can start over there and kind of start building this pipeline. I just think it's such a niche. Any thoughts about that?
Mr. Chairman, and so Representative Harshman, we sure have. We've worked with the university. We sure have. We've attended a job fair and we have discussed with them. Well, we had one of our young accountants was invited to do a session. They featured two young accountants trying to speak to students about, hey, what kind of accounting can you go into? What are we doing? We've done outreach like that. We're outreach through the foundation. We're outreach. They have a job announcement through the College of Business and that kind of thing. There hasn't been, because it's such a niche, as far as the classes, but I can certainly see if there's any interest in doing that, but I have not explored whether or not to add a class. Oh, Mr. Chairman, no, because we need upper level accounting to try to, we can't recruit these kids. That's the one thing we found when we went and did these job fairs. And I shouldn't say kids, these young people, they just don't come to us with enough, we need some background. We just don't have that kind of entry level. For our agency, an entry level accountant is a 10. And for most agencies, it's a 7, if that gives you the level. I mean, we need some, we can't take brand new accountants. Yeah.
Okay, thank you. Anything else? All right. Anything else? Senator Drew, if you're out there and you have a question, you need to speak up. All right. Thank you.
He's closing his business deal.
He's busy. He's remotely appearing somewhere. So we have, are we, as the KPMG people going to
Yes.
talk to us today?
Mr. Chairman, Julie Barrientos is here, I'm sure virtually. And
Okay.
she has a couple of folks with her and is prepared to speak with you.
Sure. All right, let's go to that. So Ms. Barrientos, are you there?
I am here, Mr. Chairman. Thank you very much.
Thank you. Welcome. We're glad to have you. And we're, I don't know how much of our discussion you've been listening to, but we're more than happy to hear your insights and your view from your perspective about how things are progressing and the organization and how this is moving along.
Very good. Thank you. And I have been listening, and a lot of what Dawn and Katie have said, I will reiterate. But I do have a presentation that I'd like to share with you, if I can get this up and running here. If you bear with me here for a second, because I think I can share. And I can. So I just wanted to kind of give you a brief sort of, try to get this to go. There we go. Perfect. A brief update of where we stand with the investment reconciliation project. And Jeff Plant, actually, I think he's still on. He has another 10 minutes or so, but Jeff and I are with you today. There you are. And Jeff is the overall engagement partner. I'm leading the team as the engagement director. And I just wanted to cover our scope of work and how we sort of approached this and a current status, and then just some very high level preliminary observations that are not going to be shockers to you based on what we heard earlier in today's meeting. So we were hired to assist with the reconciliation of the investment accounts amongst the investment custodian, the investment managers, the state's investment system, and the general ledger. And as a part of that, we are providing observations and recommendations for improving those processes and procedures related to the investment accounting. Now, we really did take a collaborative approach in working with the treasurer's office and John and Katie's team. They had a team of their own staff that were working on the reconciliations, and we also were assigned a chunk of the reconciliations to complete. But clearly, when we were hired, the prioritization was really to get through the fiscal year 21 audit. And so we prioritized those reconciliations of the managers with the largest variances for fiscal year 21. And And in 21, KPMG, our team was assigned 4 of those reconciliations, and it totaled around $14 million. And in 2020, then we were going back a year. Once we got past that initial 21 hump, we went back to we are in the process of going back to the fiscal year 2020 reconciliations. And in 2020, we were doing 33 of those, which totaled around $43 million. And as a part of that, we were documenting the current state reconciliation procedures and identifying gaps against some of those leading practices. And, when we were starting with that prioritization in fiscal year 21, I heard talking about the mapping between how you get from the balances and the entries that Katie sends over to the state auditor's office and how you get to the ultimate financial statements. And that is a gap right there. It was difficult for us to sort of tie that together. So we are in the process of finalizing that accounting memo that links those spreadsheets to the balances to better map that process. So.
And has the state auditor's office been cooperating with you in that regard?
We met with them once and to walk through it, and that's about it. So I don't know. They were helpful at that point, and I think we received what we needed to get to the sort of underlying mapping. But from that point on, we haven't had any contact with them.
Okay.
And so as far as when we go into the current status, the priority fiscal year 21 investment reconciliations are complete. So there's no longer a holdup in that audit. We have developed sort of an intuitive job aid for the reconciliation procedures so that we can bring people on and hand them this job aid, tell them which reports to look at, because this is a very manual process, which reports to look at to compare and find where the variances could potentially are. So we've done that so that we can bring people on to help sort of divide and conquer and really get the bench strength behind the reconciliation process to make it go quicker and to map out that process, how it goes into the financial statements. And so the remaining investment reconciliations that are in progress were targeted to be completed by June 30th. And I think we will make that target date. And these preliminary observations, you've already sort of covered these in some of in what I've heard earlier in this meeting, but the reconciliation process is painfully manual. And it's a matter of pulling things out of the system and comparing them to the manager reports or to the custodian. And it just takes a lot of time to weed through that manual data to be able to figure out where the variances are. And to Dawn and Katie's point, every investment manager is a little bit different. So it's as part of trying to standardize it, it's been very difficult from that process. And the reconciliation procedures really weren't fully documented. So, at the end of the day, I've done a lot of these projects, and what we strive to get to is a job aid that is very standardized. Here's the common reconciliation problems. Here's where you need to work, so that as you bring people on, it's not as big of a lift to train them through the process. And I think just through the way that these reports are structured out of QED currently, it's difficult to do that. When we first were hired, I kept thinking this can't be that hard. But as we were more integrated into the details of how the reports were coming out, we realized that it is very manual, very difficult, needs a lot of help. And I think the upgrade of that QED system is really going to help. It's going to allow the treasurer's office to get the types of reports out in the format that they need to be able to reconcile it back to the custodian and the manager. And in conjunction with that, there needs to be, as we go through each of these manager reconciliations, there needs to be some standardization between the manager and the custodian too. So we're also looking at what's different between the managers and the custodian, and why are those errors coming up, and what needs to change so that going forward, the reports that are coming out of the custodian. The custodian's getting the reports that they need from the managers so that they can provide that information back to the treasurer's office in a more streamlined fashion. And so, now is the time really thinking forward to, as this new QED system is going to play, what can we automate through this process? A lot of this, a lot of the problem or a lot of the time is spent comparing the balances when there are a million reconciliation tools out there that can do that for you. So it's just spitting out the variances. So all you're really doing is trying to figure out what the variances are, as opposed to what's my variance and now what do I need to do to fix it? And so that's really what we're focusing on right now. And I will pause there and open it up for questions.
Thank you. Questions? Questions? The question I have for you, and thank you for your time and for your explanation today. So are you kind of at least from your perspective looking at the reports and the report plan that's coming out of the effort with Broadridge and how that's going to work, and if that's going to get where you think the treasurer's office needs to be?
It is our goal to be able to be a part of that process in phase 2 once they start looking at some of the reconciliation procedures that need to happen.
Okay. Go ahead, Representative Obermuller.
Thank you, Mr. Chairman. Just a question about going forward in the process as far as the mapping issues related to all this. Can you talk to us about how you visualize the division of responsibility in terms of making that reconciliation happen as between the treasurer's office and the state auditor's office?
It's my opinion that at the end of the day, when the state auditor's office posts the entries, that there should be a back end check to make sure that the entries posted correctly and that the balances that are reflected in the financial statements are in line with what is in the treasurer's office. So I would highly recommend there be some collaboration at the end of the day on that aspect.
Mr. Chairman, follow-up question. How would you characterize this lack of mapping in terms of the current, in terms of how would you characterize the deficiency from an auditing standpoint, that lack of mapping?
I would have to defer that to the auditors, Mr. Commissioner. That's they're in their boat.
Okay, thank you.
Mm-hmm.
Go ahead, Mr. Vice Chairman.
Thank you. Just for to kind of help us fill in this picture, how long have you, KPMG, been working alongside and with the Treasurer's Office so far?
Mr. Commissioner, we have been, ever since the beginning of the project, we have been working alongside with the Treasurer's Office, hand in hand, shoulder to shoulder with them as they, as their staff reconciled managers and as we were augmenting their staff to help reconcile as well.
And that, when did you start?
January, I believe it was.
Okay. And so how much of that is, are you doing this remotely, or are part of your staff here working hand in hand? How does that work?
We have been remote the entire time. We have had regular checkpoints. At the beginning, I believe we were day to day. I think we've scaled those back a little bit now that we have our legs underneath us to, I think, 2 or 3 times a week we meet with Katie and her group.
And so I'm curious, and you said that it is painfully manual. Is that a common occurrence that you run into in the type of work that you do, and the process of then going from manual to automated?
It is more manual in the aspect of the amount of spreadsheets that are used to accumulate the data and to reconcile it back. It is more so than what I've seen typically in an investment group.
And so,
And a lot of it, and I'm sorry, let me supplement that. A lot of that does hinge on how the reports are coming out of QED for them to be able to trace that back into the managers.
and so in terms of your evaluation of phase two, are you comfortable with the current calendar of in terms of when phase two begins and the likelihood of when it will be completed based upon the goals and objectives set out for phase two?
I have not been intricately involved in the timeline or in that project. We've been focusing more so on the actual reconciliation of the investment managers so thus far in our project.
Are you familiar or have experience with QED and the processes that they are adopting through Broadridge?
No, I have not been a part of the initial phase of that project. Our scope of our project was solely on the investment managers reconciliation.
And so under your current scope of work, when is that, when will you be completed with that?
We are expected or targeted to be completed by June 30th.
And then are you also then looking at follow-up? You've talked about phase two and what you might be doing. What do you envision that would be?
If we are contracted with by the Treasurer's Office, I would envision that we would look at the reconciliation process based on the new chart of accounts and the reports coming out of the new system, and help streamline the reconciliation, and also provide suggestions and for recommendations for automating those reconciliation efforts to facilitate a more streamlined and a more streamlined process to provide the reconciliations on a monthly basis or on a daily basis.
Okay, thank you.
All right, thank you. Any other questions for our friends from KPMG? Anybody else? Anybody else? All right, anything else for us, Julie?
I don't have anything else for you, except thank you very much, Mr. Chairman, for having us.
Thank you. We appreciate your time this morning. And just going back, I just wanted to ask Katie and Dawn, are you guys going to go back and have KPMG kind of look at this and say if this is going to where they wanted to, or is there, and if we need to talk about this later, we certainly can.
Mr. Chairman, I don't understand the question exactly.
Well, I mean, you've had KPMG doing these. They've kind of come in and they've said, man, this is manual and we want to find a way to streamline, and we want to see if we can get this into the mapping so we can get this for the auditing. I'm just wondering, are we taking advantage of those insights, or are we not that far yet? Or just wondered how you saw this point going forward. And as I say, if we need to have this offline, because maybe you don't want KPMG to hear that, but we certainly can do that. But I was just trying to see if we're getting to this. There's a lot of knowledge and a lot of effort on your behalf, and brought these people up to speed. They've now been there and provided a lot of insight for you. I'm just wondering if we're taking advantage.
Mr. Chairman, I sure hope so. I mean, that's one of the things that's identified in the scope of the current contract is for them to identify processes to try to have some standardization if it's at all possible. And frankly, it's nothing we didn't already know, but that we had these problems. Obviously, we knew that we were working on reconciliations. We've done that all along. We've known that there are complications with that and through managers. We've never tried to standardize the process as far as probably a formal description of step 1 to step 2 to step 3, because we don't find that it's that easy. It's not that direct. So we are totally open. That's part of what, like I was saying, is part of the scope of KPMG's contract, is to identify processes improvements for us, and we're incredibly open to that. Would you like to add anything, Katie?
Yes, Mr. Chairman, I think we're not quite there yet. I think they're still learning. They're still in a lot of the learning phase. They just started working quasi independently on some reconciliations. I'm hoping to get my first few from them that they've worked on independently by the end of this week, so I can review and see how they look and see what they've come up with. So
And the they is KPMG?
they is the KPMG. So I don't think we're there yet, which is why we're focusing on these reconciliations, giving them that foundation. I can validate the way that they're going. Are they kind of are they on the right track? And I'll be able to do that hopefully by the end of this week. Hopefully by Friday, I'll get my first few. And then with that, absolutely leverage all of this time, all of this knowledge share to propel us into phase 2 and make those advancements once we have some additional automation with the system.
Okay. All right, thank you. All right, anybody have anything else? Anybody have anything else for right now? All right, so I think that gets us through. We're ready for the investment update, but it's also lunchtime. So why don't we come back at 1:15? I was gonna say 12:15, but that's not very long. Why don't we come back at 1:15 and we'll start up again with the investment update, Patrick, okay? Oh, is that some, Ms. Treasurer?